Hello guys, welcome to Halson Academy. This is C.S. Kumar. So welcome to CFR Marathon Part 2. Okay, I think everyone is eagerly waiting for this. So in this Part 2, we are going to cover Ind AS 116 business combinations and valuation of shares and some theory topics. For theory, only the new theory topics only I will discuss here. The balance theory you can listen, you can watch in Marathon 2.0. So in that total theory is that's more than enough. Okay, the material will be in the Telegram channel. Okay, now the CMA challenge is the Telegram channel name. So the link is available under the YouTube video. Under the video, you will find the Telegram channel link. Okay, clear. Let us start Ind AS 116. So see, these are the topics we are going to cover under Ind AS 116. First, initial intro. So definitions and accounting in the books of lessee books and lessor books, as well as one more special one, unearned finance income. It is under lessor books only, and sale and lease back. Okay, now I will give a complete clarity about this. Okay, we cannot solve all the questions, but we'll try our level best within the time frame. Okay. Okay, now start cheddama. Let us start. Okay, guys. Okay. So come to Ind AS 116 leases. So first of all, just I will give a brief about the leases. Okay, I will discuss only examination point of view, not more than that. What is required, I will discuss. That's it. Okay, simply leases is a contract. Leases is a contract which provides a right to control the use of identified asset. What is it? Right to control the use. Simple, sir. So in leases we have two parties generally. One is lessor, second one is lessee. Lessor is the owner of the asset. Lessee will use that asset. Correct? Nothing but he will get a right to use that asset. Nothing but right to control. So contract provides right to control the use of identified asset. What is that? Identified asset. That is underlined that point. To lessee for a period of time in exchange for consideration. Ultimately, who will get the right to control the use of identified asset? Lessee will get. Okay, we will give freely or for consideration. Yes, for some consideration. In exchange for consideration for a period of time. Period of time means it may be 5 years or 6 years or 10 years, whatever may be. Okay, na? So right to control. Contract. Please read the definition once again. It's a contract that provides the right to control the use of right to control the use of what is it, sir? Right to control the use of identified asset. That asset should be identified, sir. Explicitly identified or implicitly. Suppose example, lessor have two cars actually, two cars. So the person asked that, sir, I want the two cars for a lease purpose. Is it required to mention specifically? No, not required. So it's implicit. Suppose example, you have one Range Rover car, one is a Tata Indica something. He asked that, sir, I want Tata Indica car on a lease basis. Yes, it's explicit, specifically, because it must identify that asset. Okay, you have a lot of cars, hundreds of cars. He asked that, sir, I want one car. So there is no specification here, correct or not? Yes. So asset must be identified. Okay, now so right to control means whatever the benefits must be substantially taken by the lessee only. That is the meaning of a right to control. Because here lessee is using that asset, whatever the benefits is getting from the car must be taken by the lessee only. That's the right to control. He can direct the use of the asset. If you want, he can direct the use of the asset. Suppose the example is given to some other driver or some other person. Okay, he can restrict that. He have a control. Does he have a control on that asset? Correct or not? Yes. Okay, now yes sir, no? Yes sir. So one more point here I want to discuss. Sir, what is the date of a lease? So date of lease is of two types generally. One is inception of a lease, one is commencement of a lease. Inception of a lease means, so MCQ purpose very important. So generally accounting starts from which date? Inception of a lease or commencement of a lease means commencement of a lease. That is the MCQ point. Inception of a lease means date of lease agreement committed by the partners Okay, sorry, date of lease agreement or commitment given by the partners, whichever is earlier. So today, actually, I have not taken the asset on a lease basis, but entered into an agreement. Or he's my colleague or my friend. So he has given a commitment to me. So whichever is earlier, we need to take as an inception of a lease. This date is used to check whether the contract is a lease or not. So we need to check that. We can classify whether it's a finance leases are for two types: finance lease and operating lease. Correct or not? Yes. We'll discuss just wait. So commencement of lease, data on which the asset is provided by the lessee to lessor, lessee by lessor, provided to lessee by lessor. Accounting of lease is done from this date. So you know about the objective. Objective is simply accounting treatment, and the scope means it is the exception. For this Ind AS 116 not applicable. Even if it is on lease basis, standard not applicable. Please give single reading for this. That's it. Next, lessee books, recognition exemption. So they're having some recognition exemption. If it is a short-term lease, okay, we cannot classify, we cannot treat as per Ind AS 116. It's an exemption. It's a lease at a commencement date. Lease term is how much? 12 months or less. If the lease term is 12 months or less, then it comes under short-term lease. And lease payments recognized as an expense on SLM basis or systematic basis. Generally, we can recognize the expense, not as per Ind AS 116. And also one more point, and does not have an option to purchase underlying asset. Lessee does not have an option to purchase underlying asset. This option must be there, otherwise it comes under 116. So lessee don't have an option to purchase the underlying asset. That's the second more point. One is the lease term is less than or equal to 12 months, and second one is does not have an option to purchase the underlying asset. So for the example, initially on commencement date, so they have decided that lease term is 9 months only, and later it was increased to 15 or 16 months. Can we say it's a short term lease or not? Yes, it's not a it's not a short term lease or not. So one more time I'm repeating the example. Initially I thought that it is a 15 months. I told that a reverse point. Initially the term is 15 months. Day by day the period becomes reduced. Suppose the example, if it is 9 months only, can we reclassify it as a short term lease? No, don't do like that. Are you getting my point? Subsequent recognition is not a short term lease. If it is, even if it is less than 12 months, it's not a short-term lease. That's it. I don't want to discuss more and more points. And lessee for which underlying asset of a low value. Then also recognition exemption applicable. For these two conditions you need to satisfy. One is the lessee can benefit from use the underlying asset on its own, or together with other resources that are readily available to the lessee. So lessee can benefit from use of that underlying asset on its own. Suppose example, car. Okay, he can use that car. Correct or not? Yes, he can benefit from that underlying asset. That asset is not highly dependent on other assets. Suppose example, when we purchase the car, when you take a lease, when you take a car on lease, definitely you will get along with the car, you will get a tires also. Correct or not? If you take a laptops, 100 laptops on lease, you will get a chargers also. Okay, now so small items of furniture, everything comes under low value of a asset. Low value. Okay, now so the point is saying that lease for which the underlying asset of low value qualified for exemption. Recognition exemption. Head lease do not qualify as a low value asset. Note this point for MCQ purpose. Head lease do not qualify as a low value asset. So head lease means, suppose example, I lease the asset to B lease the asset to C, A lease the asset to B lease the asset to C. This is sublease, this is the head lease. Okay, this is not qualified as a low value asset. So I think already discussed about the identified point. And one more point, note this for theory or MCQ purpose. Suppliers should not have substantive right to substitute the asset. In case of identified asset, supplier do not have a right to substitute the asset. Suppose example, supplier wants to, Arey Babu, please change that car, I will give one more car. Is it possible in that lease? No. If it is possible, if it is not an identified asset. If it is not possible, then we can call it as an identified asset. That is a point. One more point under identified asset. That's it. Okay. So right to control means substantial benefit to the lessee only, and lessee right to use the right to direct the use of the asset. So already discussed about this. For example, lease land. You have taken land on a lease. You can harvest that something crops. It's everything is your wish. Correct or not? Or you can give to some other person also. It's your wish. You can direct the use of the asset. That's it. So directly come to accounting in the books of a lessee. Very important. I will discuss very quickly. Okay now. So come here. Lessee shall initially recognize lease liability and a related ROU asset. What is ROU asset? Come here. See, lessor, lessee. Lessor, lessee. Lessor is the owner. Lessee is the tenant, like a tenant. Lessor will get lease rentals every year. Correct or not? Next, lessee will get a ROU asset. ROU asset means right of use asset. Right of use the asset. Who will get that? Lessee. And also lease liability also arise. He needs to pay lease liability. Nothing but lease rental. So lease liability also arise. At a time, one asset will come as well as one lease liability also will get arise for lessee. For lessor, only he will get a lease rentals. Correct or not? Yes. Say yes or no? Yes. So I am talking about the lessee point of view. So lessee needs to calculate that lease liability. So initially recognize that lease liability only. Lessee shall initially recognize a lease liability and related ROU asset also. So he needs to calculate both at a commencement date only, not an inception date. Correct or not? You need to calculate. Lessee needs to calculate lease liability as well as ROU asset. So lease liability means come to him here. At the present value of lease payments to be made by the lessee over the time lease term by using a discount rate. Simple, sir. You need to bring the every year lease rentals to the present value. Every year lease rentals to the present value. That is nothing but a lease liability. So see the pro forma here. So I think everyone knows the calculation under Ind AS 109. Correct or not? So present value calculation, everything everyone knows about it, right? Their cash flows here. Lease payments, simple. Here, lease payments, present value factor, present value of lease payments. Suppose example is 5 years, 1, 2, 3, 4, 5. Lease payments every year 50,000 example, 50, 10% rate, you can calculate the present value. Then you will get a, what is that? Present value. Correct or not? So, on that lease liability, we need to calculate the finance expense. Correct or not? Interest expense, sir. Every year we need to calculate the interest expense, right? Correct or not? Amortization tables are under Ind AS 109 also we calculated amortization table. Take a debt component into interest rate minus payment, we will get closing value. That amortization table also we need to calculate here. Okay now. So one more point I need to discuss here, that is residual value. Expected residual value. So this residual value will be expected at the end of the year, at the end of the lease term. So this is divided into two types. One is GRV, second one is UGRV. GRV means a guaranteed residual value, UGRV means unguaranteed residual value. GRV plus UGRV equal to residual value. Suppose example, if it is a 1 lakh, guaranteed residual value 70, balance 30,000 is nothing but unguaranteed residual value. Guarantee, generally guarantee will be given by who, sir? Lessee will give the guarantee. Lessee will give the guarantee for that particular amount, some amount out of that residual value. Or lessee can you, or by any other independent party also can give a guarantee for this on behalf of lessee. Okay now. So that is nothing but GRV. The balance is UGRV. For lessee books only we need to consider that GRV only. UGRV will not consider in the books of lessee because it is out of the syllabus for lessee. But in case of a lessor, both GRV and UGRV also we need to consider. Please remind this point. Please remind this point. That's it. Okay, now. So present value of lease payments I am talking. What is the lease payments? Simple, sir. It means the payments made by the lessee over the lease term. Simple, fixed payments. Less, is there any incentives received from lessor? We need to minus that. Is there any incentives received from the lessor? We need to minus that. Clear? Are you getting my point? So generally lease rentals, fixed payments means generally every year lease rentals will be there. Correct or not? That we need to be take. We need to take that. That's the lease payments. Clear? Next, payment linked to interest rate, LIBOR, inflation index are included using interest rate on lease commencement date. So sometimes this LIBOR rates or inflation due to inflation index, the payments also may be increased. Suppose example, if the LIBOR is to 2%, suppose example the first year lease payment is 1 lakh, for second year it will become so 1 lakh plus 2%. For third year 1 lakh 2000 plus 2%. For fourth year the balance on third year plus 2%. So that's it. That's the calculation. See here, 1 lakh plus 2%, 1 lakh 2000 plus 2%. So like this we need to calculate the LIBOR rates. And nothing but payment, if the payment is linked with the LIBOR, we need to add this to the payments value. This is the MCQ purpose important. Okay, now. So generally guaranteed residual expect to be paid by the lessee at the end of the lease. Okay. Next, lease term means original period plus important for MCQ purpose. Lease term means original lease period plus expected renewal period. Sometimes initially we will discuss in the agreement between the lessor and lessee, renewal period also may be involved in that agreement. So both we need to add that for lease term. Correct. For discounting will give the discounting rate, no need to worry for that. So fair value of asset under lease means present value of lease payments made by the lessee plus present value of UGRV. So just ignore this. We'll discuss in lesser books. Please ignore this simply. Don't go that point. Don't go to that point. Come to right of use asset. We are done with lease liability. Lease liability means present value of a lease payment. Simply present value of a lease payments. Here in this book, in the books of lessee, we need to consider GRV also. Correct or not? Yes. Everything we need to bring to the present value, we will get lease liability. In first year, generally lease liability is nothing but ROU asset also. ROU asset value is nothing but a lease liability initially. So for calculating ROU asset separately, we need to consider few more points. That is lease payments made before commencement date. If the nothing but lessee made the payment before the commencement date, any payment made by the lessee before commencement date, we need to add to the lease liability. Okay. And is there any incentives received from the lessor? We need to reduce from it. Is there any initial direct cost incurred by the lessee? We need to add that. Next, and also present value of dismantling cost. Is there any present value of dismantling cost? We need to add that. Then you will get the ROU asset. We have one small question also on this ROU asset. We will calculate there. Okay, now. So first of all, in first year, lease liability and ROU asset will be the same. Most of the cases same. But if the question says about this any of the points, you need to add to the lease liability. Then you will get ROU. So at that point of time, both will become changes. Correct or not? Yes. Yes or not? Depreciation is charged on ROU asset over lease term. Obviously, depreciation we need to charge because it's a okay now. So under lessee books, as per Ind AS 116, we need to calculate the depreciation on ROU asset. Okay, now our lease term under SLM method. Correct or not? Next, so ROU asset should be shown as per Ind AS 16. Either cost model or a revaluation model, it's your wish. Simple. That's it. That's more than enough for lessee books. We need to discuss about the entries, right? So simple, sir, at commencement date you will get asset ROU asset account debit. Suppose example, if you got any incentives before commencement, you need to debit that. So bank account debit. Next, general entry is ROU asset to lease liability only. This is the normal entry. Okay, now. But if you got any cash or bank balance regarding the lease incentives, we need to debit that. Any initial direct cost lease payments, nothing initial direct cost made by the lessee, you need to credit that because you are paying. Any dismantling cost also given in the question, you need to credit that because we are not paying, we will not pay the dismantling cost at year 1. We will pay at the end of the lease term. So we need to consider it as a liability. So nothing but we need to create a provision for that. So two provision for dismantling cost. We'll discuss in this one 16 also already this point. We already discussed it there. Entry ROI asset to lease liability. ROI asset account, lease liability account. So that is only the entry generally. Mostly that entry only will come. But if you got any incentives, bank account should be debited. If you paid any amount, initial direct cost, you need to create the bank account. So provision for dismantling cost. That's it. So every year you need to calculate you need to prepare the amortization table, right? On that every year interest will be there. So what is the entry? Finance cost to lease liability. Finance cost to lease liability or interest expense to lease liability. Depreciation entry, depreciation to ROU asset. Depreciation to ROU asset. For payment, lease liability to cash or bank. Lease liability to cash or bank. That's it. So every year these entries will repeat. So steps to solve the problem. Calculate lease liability, initial recognition, calculate ROI asset, next calculate depreciation ROI asset and closing balance like this. Year opening balance, depreciation, closing balance. Next step number 4, calculate finance cost on lease liability and its closing balance at the end of year using amortization table. Remember Ind AS 109. Okay now. So we will calculate interest on lease liability only, obviously liability component. Next, past journal entries. Past journal entries. Clear? Okay now guys, everyone. So this is one example. This is more than enough for solving every question. Okay now. Clear? Simple basic question I discussed here. Simple steps actually. Very simple steps. Okay. No issue. I will discuss one problem. Don't worry. So, A takes an equipment on a lease for 3 years. Lease payments are 1 lakh are to be made at the end of each year. Discounted 10%. Okay now? Clear? So, past journal is for first year in the A Limited. So before going to that, we have 2 questions, right? That is question number 1 and 2 and 3. Okay. This question is in the books of Lessor. This question is in the books of Lessor. Sorry, lessee. In the books of lease liability. Okay. In the books of lessee only. See here, entity L enters into lease for 10 years with a single lease payment payable at the end of the beginning of the year. So this point is very important for every student. If the question is asking about, if the question is saying about the beginning of the year that they are paying the amount, lease payment paying at the beginning of the year, when we are calculating the present value, don't take any present value for first installment, first lease payment, because today beginning of the year means they are paying today only. Today value will not changes. No need to bring to the present value. So we will take the present value factor as 1. Second payment will made at the second year beginning, which means first year ending. So we need to bring a 1 year present value. We need to take the 1 year present value factor. See here. First year payment 1 lakh, whatever may be the payment, the discount factor is 1 only we need to take because the paying at beginning of the year, payment date. If the payment at ending of the year, we need to take this one because it is 5%, right? 1 divided by 1.05. You will get 0.952. That amount we need to take here. For second year, 0.907. So like this we will calculate if the question is saying about the payment made at the ending of the year. Ending of the year. If it is beginning of the year, for first year you need to take 1 only and then calculate for every year. Because it's the first year starting, this is second year starting, which means first year ending. So 1 year only, for 1 year we need to bring to the present value. This is third year beginning, which means second year ending. So 2 years value. So like that we will calculate. Okay, now I think everyone has clarity. Otherwise, you want to repeat the video. That's it. Initial lease payment 1 lakh and the LIBOR rate is 2%. So LIBOR rate is given, right? So interest rate is 5%. LIBOR rate is 2%. So LIBOR rate should be linked to the payment, obviously. So 1 lakh is the first year value. For second year, it becomes 1 lakh plus 2%. Third year beginning 1 lakh 2,000 plus 2%. 1,04,040 plus 2%. 1,06,121 plus 2%. So like this we'll calculate for 10 years. And then bring to the present value. You will get the present value of, lease liability amount. Simple question, sir. Is there any difficulty in this question? Nothing difficult, sir. Nothing difficult. It's a marathon. So I want to complete very, very fast. So I think no one can complete within the time frame also this topic. It will be more helpful to you. And second question, NT buyer jet executed 12 years lease a rail car with the following terms on 1st January. Lease commencement date 1st February. NT buyer must pay NT jet the first month rental payment is 10,000 upon execution of lease. What is the meaning of it? For executing the lease means which is the before commencement date, sir. This 10,000 is the before commencement date 10,000. Okay, lessee paid for that. Z will pay entity Y. Z is the lessee, Y is the lessor. So 50,000 cash incentive. Sorry. So Z is the lessor, Y is the lessee, right? No. Correct or not? So please read the question clearly, sir. Entity Y paying to Z means Y is the lessee, Z is the lessor. That's it. That's we need to identify firstly, initially. So Y incurred 1,000 as the initial direct cost on 1st February. Okay. Next, MT Y incurred the lease liability as the present value discount using the borrowings. How much? 8,50,000. Initial liability also given in the question. So lease liability given. So what we need to calculate right now? What we need to find out? Lease liability given, initial direct cost given, commencement before some cost incurred, incentives received, which means one word you will strike that. It must strike that. What is that? ROU asset. You need to calculate the ROU asset. So lease liability plus initial direct cost. Any incentives received, it should be minus. Any payments made before commencement date, we need to add that also. So see here, 8,50,000 plus 10,000. These incentives before commencement date minus 50. Initial direct cost 1,000. Total 8,11,000. Correct or not? Everyone clear about it? Yes. Clear? That's more than enough. Next, I will show the calculation of first one problem in the books of lessee. That's more than enough. Real limited has an equipment 3 years, payments 1 lakh, 10% rate interest. See here, first of all, lease liability. Every year payments how much? 1 lakh. So every year 1 lakh, 1 lakh, 1 lakh. Present value factor that of 10%. So we got this value. Simple calculation. Yes. In this question, there is no guaranteed value. If the guaranteed value is given, you need to take that guaranteed value also at the end of the third year only. Okay, now if the guaranteed value given, you need to take that guaranteed value also. Next, ROS, lease liability equal to ROS 2,48,600. Is an initial direct cost? No. Any payment made before commencement date? No. Any incentives received? No. So directly we can take it as a ROU asset. And then calculate the depreciation on that for 3 years. 2,48,600 divided by 3. We got 82,867 for 3 years. 1, 2, 3. This is the depreciation calculation. Step number 4, finance cost using amortization table. What is the lease liability? 2,48,600. I'm going very fast actually. I know about it. Okay. Because no need to keep in a 1.5 speed also. This is more than enough. Correct? Yes. Obviously you will go through that 1.5 or 1.75 speed. No, I know that. So I'm not giving any chance to you. If you go to that 1.52 speed, you will not understand. Okay. Year 1, year 2, year 3. Right? So opening balance, interest payment 1 lakh. This is the closing balance. Same for every year. That's it. And then come to journal entries. Asset to the lessee, ROE asset to lease liability, 2,48,600. And then year ending interest amount. So finance cost to lease liability, 24,860. This is the interest amount. Payment, lease liability to bank, 1,000, 1 lakh. Depreciation to ROE asset, 82,867. So like that we'll calculate for every year. That's it. Okay, now this is a presentation in the books of in the financial statements. ROE asset, the balance we need to take. First year already completed, right? So balance how much? 1,65,733. So this is also lease liability balance after considering all these entries. Okay, now that's more than enough in the books of a lessee. Clear, guys? Where is lesser books? Yeah. So come to lesser accounting. So generally lease is of two types. Okay, one is a finance lease, second one is operating lease. Operating lease means simply risk and rewards will not transfer to the lessee. But in case of finance lease, risk and reward and substantial all risk and rewards will be transferred to the lessee. So for if you want to say it's a finance lease, it has to satisfy the five conditions. Okay, so not five conditions, any one condition. If it is satisfied, it comes under finance lease only. Theory purpose very important. So operating is generally transferred to P&L, whether it's income or so for lesser point if it's an income, right? So lesser income transferred to P&L. That's it. So operating lease is not an issue, but finance is a very big issue. That's it. So conditions are finance lease. So you need to remember at least 4 points. That's more than enough. So simple, sir. Ownership of the asset will be transferred to the lessee at the end of the lease. That's the first point. Ownership of the asset must be transferred to the lessee at the end of the lease. And second point is lessee has an option to purchase. Lessee has an option to purchase the asset at a price expected to be lower than the fair value of the asset. If you have an option to purchase that asset less than the fair value of the asset, then it comes under finance lease only. Next, lease term covers the majority part of the life of the asset. If the life of the asset is 10 years, lease taken for 8 years. So generally more than 75% taken by the lessee, then it comes under it's a finance lease only. It comes under finance lease. So major part. Okay now. Next is fourth point important. The present value of lease payments by lessee substantially covers the fair value of asset at inception date. What is it? Present value of lease payments by lessee substantially covers. Substantially means generally 90% or more generally. Fair value of asset at inception date. The question is given in the point is given in the question. Fair value of inception date. So the present value, if you calculate the present value, it must be nearly equal to that value. Then it becomes we can call it as a finance lease. We can classify it as a finance lease. As it is of specialized nature, they should not have any major modifications. So for example, if the lessor given for only one floor, you may have constructed two more second floor. Is it possible? No, don't do like that. Okay now. So that's not the important point, but first 4 points is very important. Okay, accounting for operating is very simple. So lessor shall recognize the lease income on SLM basis over lease term. Okay, so simply charge depreciation by the lessor only, not lessee. In that case, lessee, finance lease, but here lessor. Lease income, bank to lease income, depreciation to asset. That's it. Now come to finance lease in the books of lessor. Okay, these are the points, sir. Very important points. De-recognize the carrying amount of the asset. So simple, sir. I am lessor. I am giving asset to lessee. So my asset should get reduced. So asset account credit. So next, I should recognize the lease at a net investment in lease. In the books of lessor, I should recognize that a net investment in lease. Any profit or loss should be also be recognized. Okay, that's it. Simple. This is a simple question. Are you getting my point? So what is the entry will be? Net investment in lease account debit to asset account, or net investment in lease means lease receivable account. Lease receivable account debit to asset account. That's it. Lease receivable account debit to asset account. So profit or loss should be transferred to P&L. That's it. Profit or loss should be transferred to P&L. One more point for MCQ purpose in the finance lease, if the lessor is a manufacturer or a dealer, okay, is not a manufacturer or a dealer, this is the point. What is that? Initial direct cost. Initial direct cost should be included in the initial measurement of lease receivable only. Don't add separately. It automatically include in that lease receivable amount. But in case of a dealer or a manufacturer, you have to add separately. That's it. MCQ purpose. So NIL means net investment in lease means present value of lease payments plus present value of GRV. Present value of lease payments means present value of annual lease payments plus present value of GRV also. I already discussed about this point. And in the lessor books, we need to consider GRV plus UGRV also. So present value of annual lease payments plus GRV plus UGRV. You will get net investment in lease. Okay now. Clear? So that's the entry. Finance lease receivable account debit to underlying asset carrying amount. For selling profit or loss, what is the formula for selling profit or loss? Simply fair value of underlying asset. If it is given in the question, you can take that directly. Or you can calculate the finance fair value of lease receivable amount. Okay now. So minus carrying amount of asset net of UGRV. You will get nothing but sir. Simple. Generally, we can call it as a COGS also. Simple. So okay. So ignore the point. Simple, sir. Fair value of underlying asset. You need to take fair value or a cost also. You can take cost. Present value of lease payments is there. That is the value I am talking about. Okay. Present value of lease payments, right? Correct or not? So that value you can take if the value is not available. So and then carrying amount minus UGR, present value of UGR. Okay now. So are you getting my point? You will get a selling profit or a loss. If the lessor is a dealer or manufacturer, you need to calculate the revenue. Revenue, how to calculate the revenue? Fair value of underlying asset or present value of lease payment, whichever is lower. COGS means cost minus nothing but fair value minus present value of UGRV, obviously. Cost minus present value for UGRV. You will get COGS. That's it. Sir, what you discussed, sir, in lesser books, I am not understanding. Yes, you will not understand. I know. Because we did not solve any problem. Then only we will understand this. Correct or not? Simple, sir. Simple point. Annual lease payments 1 lakh. Lease term 5 years. Just I will give understanding. So we don't have a lot of time, that's why. Okay, almost 40 minutes completed for only leases, right? Next, GRV, UGRV. Examples 30-20. Assume that. Step number 1, net investment in lease. You need to calculate. Simple. Suppose example discounting factor. Suppose example 10%. You need to calculate present value of annual lease payments plus present value of GRV plus present value of UGRV. You will get net investment in lease. Correct? Suppose example carrying amount also given in the question. Obviously they will give the question. They will give the carrying amount, right? So then you can write the center. That's it. So this is general calculation. General. If the question is asking about a dealer lessor is a dealer or manufacturer, then entry will becomes normal entry is what is that net investment in lease to underlying asset or lease receivable. Difference will be transferred to P&L. If you come here, net investment in lease account to revenue account, COGS account to what is that, sir? What is the pending one? Sorry. Sorry, what happened, sir? What is it? Asset. Sorry, asset only. Asset is going right. So asset account. Sorry. Yes. To asset account. This is the entry. If the lessor is a dealer or a manufacturer, this is the entry. Otherwise, simple, sir. This is also same. Revenue minus COG is what? Profit or loss. So revenue created, cost debited. The difference profit or loss only. So entry will not change actually. But if the question is given like that, please follow this. That's it. Okay now. I'm giving a conceptual clarity. That's it. I'm not doing any solutions, any questions. Okay. You need to follow net investment in lease. You already know about it. Present value of lease payments plus GRV plus UGRV. You will take that. COGS means carrying amount minus present value of UGRV. Please remind this. Revenue means present value of lease payments plus present value of GRV only. Don't take UGRV value. Asset carrying amount. That's it. This is the value. Okay. I will share these notes also. You will get entries also. We have discussed one question that is in our book actually. Okay, I will share that question also. That is not in our marathon book. Okay, now. So you can solve that question number 3, right? The question number 3 solution also here only. Clear? Yes. This is the solution for that. Okay, this is the calculation NIL. This is the revenue. This is the NIL. This is the finance income calculation. COGS calculation. If you know the formulas very well, you can crack this Ind AS 116 very easy. That's it. Yes. And last but not least, that is sale and lease back. Actually, we have lease modification also there, but for CMA final, they are not stressed about that lease modification. Even if you got a lease modification, easily you can solve the steps. Same, lease liability is common, ROU is common. Okay, now. So the first 3 steps is common for everything. Even if you got lease modification means, suppose example, every year lease payments may be changed after the 5 years. Or lease term, suppose example, from 5 years to 8 years it may be increased. That is also lease modification. Okay, that is not stressed under CMA final level. And the last one is sale and lease back. So see, simple sir. Very simple. What is the simple? Prabhas and Anushka. So Prabhas wants to sell asset to the Anushka. So Prabhas is the seller, Anushka is the buyer, right? So next immediately Prabhas wants to take an asset on lease basis. So buyer becomes a lessor, seller Prabhas becomes a lessee. So in the books of lessee, what is the journal entry? That we need to discuss. Okay now. Clear guys? So I don't want to stress this point actually. Okay, this is a CA final level very important actually. Simple sir. I sold the asset to Anushka. So in the books of Prabhas, nothing but lessee. Prabhas lessee or not? Yes, seller as well as lessee, not seller lessor. Seller becomes lessee here. Buyer becomes lessor. So lessee books I will get a cash sale value. So cash account debit. Asset will gone. So to asset account credit. Next, again I am taking on lease basis. So ROU asset to lease liability. So ROU asset to lease liability. So to lease liability. Then the difference will be gain or loss. That's it. But sale value, so, I will discuss one question also. One more point. Sale value is 1 lakh. Sale value is 10 lakhs, example. But the fair value of asset is 7 lakhs only. Generally, you cannot sell more than that fair value, right? So the difference 3 lakhs is we can call it as additional finance. We are getting extra money from Anushka. That we can call it as a financial liability. So you are taking extra money, you need to pay back. So then we can call it as a financial liability. So that's it. This is the point. When we calculate a lease liability, and in that this additional finance also will be included. You will not understand this point. Come to example, we'll get to know that. You will know this. Simple. Seller. What is it? Nag Chaitanya, Akhil. Seller, buyer, lessee, lessor. Okay na? So sale value 30 lakhs, fair value 27 lakhs, carrying value 15 lakhs. Sale value 20 lakhs, fair value 27 lakhs, carrying value 15 lakhs. Okay na? Simple. Sale value is more than the fair value. The difference 3 lakhs is nothing but financial liability, nothing but additional finance. You cannot sell more than 27 lakhs. More than that. So you sold at 30 lakhs. That 3 lakhs you are taking extra amount. Prabhas is taking extra amount, we need to pay back like a financial liability. So finance liability. 3 lakhs. Annual lease payments 2 lakhs for 20 years at the rate of 12%. Every year annual payments how much? 2 lakhs. How many years? 20 years. What's the rate? 12%. Simply you can bring it to the present value. You will get one value. That is nothing but present value of lease payments 14,94,000. If you calculate at the 2 lakhs at the rate of 20 years at the rate of 12%, you will get this value 14,94,000. Out of this 14,94,000, it is nothing but lease liability, right? Present value lease payments means lease liability. This lease liability includes that 3 lakhs amount also. What is the 3 lakhs? Finance liability. Please separate that. So finance liability is 3 lakhs. Total lease liability 14,94,000. Out of that finance liability 3 lakhs. So balance 11,94,000. Correct or not? Yes or no? Yes. So come to entry. So sale value, bank account debit, cash or bank 30 lakhs. To building carrying value 15 lakhs. Yes, 15 lakhs. So I am done with this. Sorry. Done with this. Next. Financial liability 3 lakhs. Yes, finance liability 3 lakhs. Lease liability 11,94,000. Total 14,94,000. Otherwise, you can directly write this as a lease liability 14,94,000 also, no issue for me. I don't have no issue. So I am done with these two also. Building also done. This also done. So I need to find out the ROU asset and gain. If you find out the ROU asset, you will the balance will become the gain or loss. Correct? Yes. How to calculate the ROU? Actually, for gain also you have calculation, but for CMA final level, ignore that. Just if you find the ROU asset, that's more than enough. Okay. So carrying amount by fair value into lease payments. I mean lease liability. Lease liability how much? So carrying amount how much, sir? 15 lakhs, sir. Fair value 27 lakhs. Correct? 15 by 27. Okay, nice. Into discounted lease payments. How much? 11,94,000. How much, sir? 6,63,333. So we need to take discounted lease payments means that the financial liability should exclude here. Correct or not? That's the extra financial liability. So please ignore that. And then take the proportionate value. That discounted value 11,94,000 for 27 lakhs. I want for 15 lakhs. Carrying amount. You will get that ROU asset value. Proportionate value you have taken. The balance is gain and loss. That's it. I don't want to discuss more than this. This is the Ind AS 116. Very, very important. So I have discussed almost 47 minutes to 50 minutes. Right? Almost 50 minutes we have discussed. A lot of discussion has been there. It's very important for examination point of view. It's more than enough for your exams. But you must prepare that. At least do this problem number 3. I will share the notes in a Telegram channel. No issue for that. Okay, now. Thank you. Thank you so much. Hello everyone. Good morning to all. So next topic, valuation of a shares. What is that? Valuation of a share. Simple, sir. Why we need to value the share? First of all, what's the meaning of a share? Simply, it's the smallest unit of a ownership of a company. Simple, we have a share capital. Company have a share capital. So that share capital will be divided into different parts, right? So like each part is known as a share. Correct or not? Yes. So generally we will raise the money. Companies will raise money by issue of shares. Correct or not? Yes. It is one of the sources of raising the money. Correct or not? What is the one of the source by which a company rises from the market? Correct or not? Yes. The value of a share does not remain constant. It will remains changes. Obviously, if you know the stock market, definitely we can observe that easily. It will get changes based on the market different conditions. Different factors will affect it because, suppose example, based on the economy. Okay, correct or not? So based on the nature of the business, based on the government restrictions, so there are different factors will work. Correct or not? Suppose example, if the recently Ukraine war, because of that also the share values will get reduced. Correct or not? So there are different factors will work. So then, and what is the most important purpose for valuing the share actually? Why we need to value? Suppose example, if you want to sell share to particular a party, definitely it has some value, so we need to value the share. If you want to amalgamate or if you want to merge with another company, we need to value the share, value of a share. So there are different conditions are there, correct or not? Suppose example, if you want to take a loan, okay, based on the shares keep as a security, okay, for that purpose also we need to value the share. So there are different purposes we have to value the share. So for share valuation we have a different approaches. One is income approach, net asset approach, market approach. We'll discuss mainly about these 2 points. Okay, previously in our old syllabus we have just 3 methods only: net assets method, yield method, fair value method. Now under new syllabus they have increased more number of methods for valuing the share, which is already in the business valuation. Whatever you have learned in business valuation, that is only will be there here. Okay, clear? Yeah, come to income approach. Okay, so come to income approach. So under income approach we have different methods here. One is discounted cash flow method, second one dividend discount model, third one maintainable profit base, and others. Okay, now so the first two is very important for MCQ purpose. First one is discounted cash flow model. Simple, every year some cash flows will be there, we need to bring it into the present value, that's it. So simple. One more point, value of a business. Under this, value of a business equal to value of equity plus value of a debt. Generally everyone knows about this, right? Value of a business equal to value of equity plus value of a debt. Simple, it indicates the fair value of a business based on the value of cash flows that the business is expecting in future. Whatever the cash flows they are expecting in future, based on that they will calculate the value of a business, fair market value of a business. So value of equity equal to, everyone knows about it, value of business minus value of debt, because value of business equal to value of equity plus value of debt. So obviously value of equity equal to value of business minus value of debt, correct? So how to calculate the value of a business means simply present value of aggregate cash flows. Present value of aggregate cash flows. What's cash flows? Cash flows means no PAT plus depreciation, nothing but non-cash expenses plus or minus changes in working capital. Non-cash working capital, because we will not under working capital. Working capital means current assets and current liabilities, correct? Current assets minus current liabilities, generally we can call it as a working capital. In that, cash, don't consider the cash, that's why we can call it as a non-cash working capital. Are you getting my point? No PAT means simple, net operating profit after tax. Simply, what's the formula for that? EBIT minus tax rate. Suppose example, EBIT 1 lakh, directly don't minus the interest value, directly reduce the tax rate. Suppose example 30%, 1 lakh minus 30%, 70,000, that's the no PAT. I think this is important under EVA calculation also. EVA, economic value added. Clear? So we are done with the depreciation and changes in working capital, they will give in the question. Cash flows. Free cash flows is of two types generally. One is the free cash flows to the firm and the free cash flow to the equity. Very important. If you don't know the formulas, you cannot solve the questions. If you got a question from this topic, definitely you need to know the formulas. Free cash flow to the firm. Free cash flow means that the cash flow should not include the capital expenditure. Okay, now free cash flow to the firm means that cash flow does not include the capital expenditure. So that's why free cash flow minus capex. Cash flow minus capex. Okay, now cash flow means no PAT plus depreciation plus or minus changes in working capital minus capex. Correct or not? Because we already know about this cash flow. This one, I got this formula from here. Please don't see and write all the formulas, otherwise you will not remember, right? Clear? Next, free cash flow to the equity means simple, sir. Net income minus changes in non-cash working capital minus net capex plus net debt issue. What is that, sir? What is it? Free cash flow to the equity. What is that, sir? Net income, profit after tax. Generally, we will take available to equity share also. Out of that, please non-cash working capital, please reduce that. Net capital expenditure, is there any cash flows regarding that? Reduce that. Net debt issue is if you got any debt issues, Please add that. That's it. Free cash flow to the equity. Are you getting my point? Clear? Everyone. Otherwise, one more formula. FCFE equal to FCFF minus interest net of tax plus net debt issued is one more formula. Very easy. Interest net of tax means interest minus tax rate directly. Net debt issued means debt minus debt. Simple, sir. Net debt issue will be identified easily. Okay, now. Clear? Debt issued. Net debt issued. Fund raised through debt simply. It should get added. Then you will get a free cash flow for a equity. Okay, free cash flow the firm minus interest net of a tax. Please reduce that interest. Okay, now are you getting my point? And then add net debt issue. Clear? Are you getting my point? Yes. Everyone, tell me the cash flow. No PAT plus non-cash expenses plus or minus changes in working capital. If the non-cash working capital increases, you need to decreases minus. That's it. No PAT means EBIT minus tax rate. Next, FCFF means the cash flow minus capex. Cash flow means already you know about it. Next, free cash flow the equity equal to FCFF minus interest net of tax plus net debt issued. That's it. Interest net of tax means interest minus tax rate directly. Okay, now that's it, sir. I don't want to discuss more and more. Terminal value or a continuing value. Under this only, terminal value means it can be computed by aggregating the discounting cash flows from that moment till infinity. Infinity means we will not take any number of years, any number of times. Directly we will take the percentage. Terminal value equal to, suppose example, cash flow 500, year 5, whatever maybe, the rate is 10%. So directly we will take 500 by 10%. Cash flow by KE. Cash flow by rate. That's it. Cash flow by rate. You will get the terminal value. Please remind this. If there is no growth rate, that is the formula. If there is a growth rate, then the formula is cash flow by K minus G. K minus G. K and rate of the interest or rate of cost of a capital or cost of equity, whatever maybe, minus growth rate. CF minus. Suppose example 10% is the K. Growth rate is 5%. We need to take only 5%. That's it. If there is a growth rate. Otherwise, CF by K. That's it. This is a small example which is given in the material also. Very simple question. Year 2018, 19, 20, 20, 21, 22. Okay, now. So value of business on 1/1/2021. So on this date they are asking. This is year ending date, right? This is year ending date. And every year is also 800 only. So every year 800 means we can calculate the by using a terminal value, right? Value of business equal to CF by KO. So CF by K, 800 by 10%, 8,000. So this 8,000 at the end of the at the beginning of the 2021, correct? Beginning of the 2021, correct or not? Yes. For 1/1/2020, nothing but on this date. So simply on this date, on the in the year 2021 beginning, which means 2020 ending only. So the 7,700 is also year ending. This 8,000 is also year ending. 2020 year ending. I want 2020 beginning. So directly we will bring to the present value at the rate of 10% for 1 year only. Because it is 2020 ending. I want 2020 beginning. So only 1 year. So divided by 1.1. 700 by 1.1. 8,000 by 1.1. We got the value of our business. 7908. Nothing but 1/1/2020. This is year ending. So I got the value on 1/1/2020, which means 2019 ending only. 2019 ending means 1/1/2020 only. So on that date the value is 7908. So I want value on which date? 1/1/19. So bring it into the present value for 1 year. 7908 by 1.1. This 600 is also year ending only. I want year starting. So 1 year present value. Bring to the 1 year present value factor. So 600 by 1.1. We got this answer. 7735. Just bringing. That's it. You will understand by watching again and again. Because I don't want to have a lot of time to repeat everything, right? Clear? Clear or not? Yes, sir. This is every year cash flow is same, so that I have calculated the terminal value, direct value of a business. Okay, now, so one more point, EBIT, depreciation, capex, interest, increase in non-cash working capital, debt capital, tax rate, WACC, number of equity shares, 50 lakhs. So, first question, no PAT, EBIT minus tax rate. EBIT how much? 700. Tax rate how much? 25%. That's it. Cash flow, no PAT plus depreciation plus change in working capital. So, increase means add. So, increase means only we need to minus. Okay, sorry. Net cash working capital we need to minus. Correct. Yes, minus. So no PAT plus depreciation minus changes in working capital. So we got 545. Free cash flow of the firm. Cash flow minus capex. Cash flow we already calculated minus capital expenditure 180 given in the question. Value of business based on cash flow continuing value. So continuing value means so cash flow how much actually 545 divided by rate 10% of yes 5450. Next free cash flow of the firm. Firm means what is the formula? Free cash flow to the firm, they are asking value of a business based on that value. Already calculated the free cash flow to the firm 365 divided by 10%, 365. Simple. So just we have calculated like that only, sir. Next by using the growth rate, just you can go through that. Next based on FCFF also we have calculated. Just go through all these things. In this question net debt issue is not there, so you can take it as a 0. That's it. Don't take that issue value, that value. Okay now, clear? So go through the example. I will share this notes also. Don't worry. I think everyone understand the concept. Then you can go through the solution. That's the example. That's it. Next, dividend discount model. We can also call it as a Gordon's model. Simple D1 by P0. Dividend at the end of the year divided by P0, price of the share. If the that's the value. That's the formula for KE. K means rate, for rate calculation. For price calculation, P0 equal to D1 by K. Nothing but dividend per share by K, rate. If there is no growth rate, if there is a great growth rate, then the formula becomes D by K minus G. Otherwise, D by G. That's it. D by E. Generally, D by K. If the growth rate is there, then D by K minus G. K means rate given in the question. G means growth rate. We can call it as a Gordon's model. So maintenance profit base is not that much important. Okay now, clear? This is income approach, that is more than enough. Next, net assets approach. Net assets approach is also known as a asset backing method, intrinsic value method, real value basis method, or next one more is there. What is that? Breakup value basis method. Everything we can call it. So simple is the calculation of intrinsic value per share. Simple net assets by number of equity shares. Net assets by number of equity shares. Net assets means net assets available to equity shareholders divided by number of equity shares. You will get a intrinsic value per share. Correct. If in the given question you have different types of values, you have different types of classes of shares, then how to calculate the intrinsic value? Simple. Suppose example, one type of a share, the face value 10 rupees, paid up value also 10 rupees. Another type of a share, face value 10 rupees, paid up value 8 rupees only. Then how to calculate the intrinsic value? Simple. Intrinsic value, suppose example 25. For 10 rupees face up paid up value, how to calculate? 25 by 10 into 10. For 8 rupees paid up value, 25 by 10 into 8. That's it. By face value into paid up value. Okay, now by face value into paid up value. Clear? You will get it. This is a paid up value. Clear? How to calculate the net assets? Simple, sir. You have to take the fixed assets, all fixed assets, and investments, non-trade investments, anything, current assets, goodwill, total, less current liabilities, debentures, preferential capital including arrears, and arrears means see, simple, sir. Actually, you have to take all the assets, including net non-trade investment, whatever, everything you can take. Goodwill also you need to take, minus current liabilities, any other outstanding liabilities, preferential capital. Next, preference dividend arrears. If there is any arrears in preference dividend, you need to take that also. Equity dividend also you need to take. If is there any arrears of equity dividend, you need to take that also. And lastly, you can add the notional calls. If there are any notional calls, you need to add it. What is the notional call mean? Sometimes they have the face value is 10 rupees, okay, but the called up value is 8 rupees only. The paid up is 8 rupees only. The balance 2 rupees we can call. That is nothing but notional call. Number of shares into that call amount 2 rupees. Suppose example 1 lakh shares, 2 rupees the pending call amount. So 2 lakh into 2 into 1 lakh, 2 lakh rupees. That's the notional call amount. Then you will get net assets available for equity share holders. Okay now. So otherwise simple formula, capital employed plus goodwill plus non-trade investment. Because why this formula given? Because simple, when we actually in valuation of shares we have a mostly use of the goodwill method, super profit method actually. Under that we need to calculate the goodwill first of all. Okay, so we need to, in these questions actually in valuation of shares we have to find out the goodwill calculation, nothing but under super profit. So for that purpose we want capital employed also, correct? For calculating normal profit we want capital employed, right? So for that capital employed purpose, generally non-trade investment will not be considered. Please remember that point. For calculating capital employed, don't take goodwill and non-trade investment also. For calculating capital employed, don't take goodwill and non-trade investment also. So that's why I separate the formula. Okay now, capital employed plus goodwill plus non-trade investment. This goodwill will be calculated by using the capital employed and non-trade investment. Non-trade investment don't take in case of a capital employed calculation. Capital employed means assets minus outside liabilities only, generally we will take. Okay now, these are the points. Net assets excludes fictitious assets but includes non-trade investments. Net assets available to equity shareholders includes non-trade investment, but okay, but don't include fictitious assets. What are the fictitious assets? Preliminary expense, P&L debit balance, discount and issue of shares. Don't take that. Are you getting my point? Don't take that. Next, all liabilities include the preference share capital, preference dividend, equity dividend also you need to consider. Yes. Even if the preference share given in equity also you need to consider in case of a liabilities. Next, notional cost means unpaid value, we need to call that. That's it. I already discussed that point. Next, in case of a calculation of a capital employed for the purpose of goodwill, don't consider non-trade investment, right? If there is an income arising from non-trade investment, can we consider in case of average profits? No, don't take that also. In case if average profit is given, you have to reduce income from non-trade investment from it to know the actual profit. So you need to reduce that income from non-trade investment. You need to reduce from average profit. Then you will get actual profit. Please reduce it because it's already considered. Because of that non-trade income from non-trade investment, the profit shows more. You need to minus that. That's it. Don't consider non-trade investment for the purpose of calculation of goodwill. Okay. This is the, what is it? No, net assets method. If you follow this theory, everything, you can easily calculate. Okay, once I am done with the theory, I will explain about a few problems, 1 or 2 problems, that's it, important problems. Next, yield basis or earning capacity basis. So under this we have a yield means generally rate of return on investment, So we have a profit basis and dividend basis. Simple sir. How to value of a share? Simple, capitalize the value of a profit divided by, what is it sir? By number of shares. Capitalize value of a profit by number of shares. Capitalize value of a profit means, what is it sir? Capitalize value of a profit means profit by NRR, average profit by NRR. Otherwise, one more formula for value of equity share. What is it? Profit by number of shares into NRR, normal rate of return. Okay now, clear? That is a profit basis. We are talking about profit. Suppose if you are talking about a dividend, we will take dividend. That's it. Same formula, but we will take dividend. How to calculate the dividend? Rate of dividend, profit by equity share capital. That's it. Rate of dividend, how to get profit by equity share capital, you will get the rate of dividend. Okay, here NRR means normal rate of a dividend. Okay, now don't forget about it. If you are following dividend basis method, NRR means normal rate of a dividend. That's it. Clear? Fair value means intrinsic value plus yield value divided by 2. Intrinsic value means net assets method plus yield value. Both add that, you will get the total and divided by 2. Average. Simply you have to take the average of the both methods. You will get the fair value. Next, earning per rupee. Sir, earning per share is different, earning per rupee is different. Earning per share means earnings by equity shares we will take. Earnings per rupee means earnings by equity share capital you will take. Per share value you will take shares, per rupee value you will take value, equity share capital. That's it. This is more than enough for valuation of shares. Immediately we'll go to the problems. Are you getting my point? Okay, now everyone, suppose example 10,000 shares, 10,000 shares, 10 rupees face value, 10 rupees paid up. 5,000 shares, 5 rupees face value, 5 rupees paid up. This is two different class of shares. Now, how to calculate the number of equity shares? Simple. Number of equity shares equal to 10 rupees. How much? How many shares? 10 rupees. 10,000 plus we can take directly 5,000 or not? No, we cannot take. So we need to suppose example from 5 rupees to 10 rupees. We need to convert the number of shares from 5 rupees to 10 rupees or 10 rupees to 5 rupees. Your wish. Suppose example I want to make it into 10 rupees face value of a share. So everything equal to 10 rupees. So 5,000 shares 5 rupees only. Then how many shares it will become 10 rupees? How many, sir? 2,500. Correct or not? Yes, 5,000 is 5 rupees. So if you want 10 rupees, how much? How many shares? How many, sir? 2,500. Correct or not? Yes. So this is the total number of shares, 12,500. This is the equivalent number of shares calculation. Are you getting my point? Sometimes 10 rupees face value, 10 rupees paid up, 10 rupees face value, 8 rupees paid up, 5 rupees face value, 5 rupees paid up, 5 rupees face value, 4 rupees paid up. Then how to calculate number of shares? Here even if the paid up value is different in case of a 10 rupees face value of a shares, we can take the total number of shares directly. We can take the total number of shares. How many? Suppose example here 10,000, here 5,000. Total 15,000 we need to take. This paid up unpaid value doesn't affect the number of shares. But in case of a value case, in case of a calculation of value, then it will be affected. Otherwise it won't affect. I'm talking about number of these shares will never affect it, even if it is not fully paid. Okay now. Next in this case, suppose example 5,000, here also 5,000. How many shares? This is 5 rupees. I want to convert it into 10 rupees. So nothing but half shares, 2,500. Here also half, even if it is not fully paid up. Total 5,000. Total 20,000. Are you getting my point? 15,000 plus 5,000. Total 20,000 number of equity shares. Everyone clear about this bloody burger topic? Okay now. Next. Suppose example, if we calculate intrinsic value per share 10 rupees, 10 rupees. Intrinsic value per share 10 rupees. Example, for example, I want intrinsic value per share for class 1 share. We have two class. Suppose example 10 rupees face value, 10 rupees paid up. This is one class of share. 10 rupees face value, 8 rupees paid up. This is second class of share. In this case, I want different clauses, what is the value per share? That is what I want. You also calculate this one also. The intrinsic value, generally 10 rupees. So in case of fully paid up, 10 rupees face value, 10 rupees paid up, then you need to take intrinsic value by 10 into 10. This is 10 rupees, this is face value, this is paid up value. Paid up value by face value, intrinsic value by face value into paid up value. Here, intrinsic value by 10 into 8 only you need to take. 10 rupees into 10 by 8 by 10. How much 8? Here 10. This is the way of calculation for each clause of share. Okay now? Everyone clear about this? If you are clear about this, then we will go to the remaining topic. Capital employed. One is opening capital employed. Second one is closing capital employed. Third one is average capital employed. Opening capital employed, closing capital employed, average capital employed. Closing capital employed means current year you will calculate the capital employed, right? So that is nothing but closing capital employed. Based on last year values, you have to calculate in the same way. That is nothing but opening capital employed. This will be given in the question. Opening will be given in the question. Otherwise, you can calculate also if they given the information that particular year also. Okay now. Next, obviously as usual you have to calculate this. This is nothing but a closing capital employed. Okay. What is the sober profit formula? Average profit minus normal profit. Normal profit equal to capital employed into NRR. Capital employed into NRR. What is this capital employed? We already discussed that. Okay. This capital employed, whether it is the opening capital employed, closing capital employed, average capital employed. This is the question now arises. Sir, obviously we will not take that opening capital employed when we are calculating current year. So you need to take only closing capital employed only. Closing capital, because current year, based on current year capital employed, you need to calculate that. Okay, you have to take closing capital employed. If the question itself saying that please take average capital employed, then you have to take a average capital employed only. If the question says NRR 10% on closing capital employed, if they said like that, you have to take based on which value? Closing capital employed. If the question itself saying that 10% on average capital employed, you have to take average only. Nothing said about it. You can take your wish, assumption. Whether it's a closing capital employed or average also you can take. You can take any one of them. If the question nothing says. I think everyone getting clarity slowly. Slowly you will getting clarity. You will get clarity. Okay. What is average capital employed? Average capital employed equal to opening capital employed plus closing capital employed divided by 2. Are you getting my point? Or closing just wait. This is the average profit formula. Okay. Average capital employed equal to opening capital employed plus closing capital employed divided by 2. These are all not in my book, right? You have to make notes. Unable to send these notes also because it is not a proper way, right? So I'm writing like a doctor writing. So you will never understand this writing. Correct? Yes, so you have to make notes, please. For all the topics, I am unable to send the notes. Yes, notes is very important, sir. Lot of points we are covering. It's because actually I can keep all the points in meter also, but anyone can understand with that material if we given everything. Okay, so correct or not? That's it. So average capital employed. opening plus closing divided by 2, or closing capital employed minus half of a profit after tax. What's the formula? Closing capital employed minus half of a profit after tax. Okay, now clear? Please note down. Please note down. Closing capital employed minus half of a profit after tax. So if you see in the Google, also will give the formula. See, half of the current year profit plus current year dividend also they are saying that. Current year profit after tax means current year profit. Please mind it. Current year profit plus current year dividend also we need to take if given in the question. But in our questions mostly dividend is not available, so we are taking directly this formula. Institute also saying this one only. Current year profit. Closing capital employed minus half of a profit after tax. Is it everyone? The following abridged balance sheet as on 31st March 2017 pertains to S Limited, all are rupees in lakhs. Share capital given 180 lakhs, 90 lakhs, 150 lakhs. Different class of shares. Goodwill given, other fixed assets, current assets, loans and advances, reserves and surplus, secured loans, current liabilities, provisions. You are required to calculate each one of the three categories of equity shares appearing in the above balance sheet. First one, intrinsic value based on the book value of assets and liabilities including goodwill. The point clearly says that you need to take goodwill. You need to consider that goodwill. No need to calculate any goodwill calculation here, right? So you can take that goodwill directly. That's the special point here. Based on intrinsic value. Intrinsic value means net assets method. What is the formula? Net assets by number of shares. How to calculate net assets? You already know about it. For number of shares also we need to do some working note, right? Because we have a different clause of shares. Anybody please tell me how many number of shares here? Equivalent number of shares. 180 lakhs. Here also 10 rupees. Paid up is not relevant. 90 here. 5 rupees. You need to convert into 10. So the number of shares will be get reduced. How much? Correct or not? Okay, now 345. Clear? Simple questions. So first of all, you need to calculate net assets. Net assets means total assets how much? These are the assets. Liabilities. These are the liabilities. There is no preferential capital. Correct or not? Yes. Next, is there any notional calls here? Notional calls. Please check clearly. 5 rupees fully paid up, no issue. 10 rupees fully paid up. Here 10 rupees 8 paid up. Nothing but 2 rupees is uncalled capital. Nothing but unpaid amount. So you need to call. You need to call. Okay now. That is nothing but notional call. How much? 2 rupees into 90 lakhs. 180. So that should be added at the end of the format. Clear? So this is the format. Working note number 1. Goodwill 420. No need to discuss more and more. We already know about the concept. Other fixed assets given in the question. Current assets given. Loans and advances given. Total assets. Liabilities provision given. Current liabilities given. Securities loans given. You got a net assets. Plus notional calls. So this is the total net assets. Notional calls how to get 90 into 2. Is there any discussion required for this question? Just to copy paste. Copy paste and add this notional call. You got a total net assets available to equity shareholders. Okay now? Clear? Yes. Number of shares 345 just now we have calculated. This is not 375, 75. Correct or not? 180 plus 90, 90 lakhs plus 75 you need to take because we are converting it into 10 rupees per share. Number of shares how much? 345. 8907 by 345. Please calculate. Everyone. How much? 25.817. Okay. Simply 25.8. That's the intrinsic value per share. So we are done with answer. But we need to calculate here. What is that? Each class of a share. Correct or not? So how to calculate the 25.8 divided by, if the face value is 10, okay, 10 into 10, fully paid up. Second case, 25.8 by 10 into 8 rupees paid up. Third case, 25.8 by 10 into 5. 5 rupees only, sir. It is equal to 10, but I want 5 rupees. Please calculate. First one is 25.8. Second one, 20.64. Third one, 12.9. Simple. I want 5 rupees paid up, sir. 5 rupees paid up. But so that's why I have taken 5 rupees. Third case is 5 rupees only. Clear? 5 rupees paid. Is there any difficulty in this question? Nothing difficult. Very simple question. This is the way of understanding, sir. You can solve it easily. Second, value per share on the basis of dividend yield they are asking about. Normal rate of dividend in the concerned industry is 15%. Nothing but NRR. Okay. Glorious has been paying 20% dividend for last 4 years. So this is the dividend rate, 20%. And expected maintenance for next few years. Okay. So dividend rate of dividend given, normal rate of dividend also given. Okay, normal rate of return, nothing but dividend is also given 15%. You need to calculate the value of a share. What is the formula? When the rate of dividend is given, rate of dividend by paid up share capital into NRR. Correct or not? See, dividend yield divided by NRR into paid up share capital. You need to take a face value. Okay, no issue. So dividend yield, how much? 20% dividend rate. 20% dividend rate. Paid up share capital 10 rupees, right? Paid up share capital 10 rupees into NRR how much? 15%. NRR how much? 15%. How much? How much, sir? Yield value in the terms of percentage, right? We need to take into 100 also. How much? 13.33. Next, 20 by 8 into 15 into 100. How much? 20 by okay. Sorry, what is the formula we have discussed actually? Paid up share capital is not in denominator, I think so. Sorry. Just wait a moment. So actually for editing work I have given to someone, some mistakes have been happened. Okay, rate of dividend by, sorry, NRR into paid up share capital. Okay, sorry, this is correct actually. This is only the correct actually. The formula, please change that. Not in denominator that paid up share capital, it is under numerator only. So rate of dividend by NRR into paid up share capital. This is only the correct. Sorry for this. Sorry for this. So then 20 by 15 into 10. 20% by 15% into 10. In second case, 20 by 15 into 8 rupees only the paid up value. Third case, 20 by 15 into 5. 5 rupees paid up. So calculate. 20 by 15 into 8. How much? 10.67. Next year. 6.67. So answers are all are correct. Answers all are correct. So 13.3, 10.67, 6.67. Sorry for this. Clear? Okay now. Nothing to worry. Nothing to worry. Don't get confused. Okay. Just a small correction. Sometimes happens. Correct? Okay. Is it clear, everyone? Please change that formula. I think very simple, sir. Just a substitution only we are doing. Nothing doing here. Is there any thinking required here? No. If you know the formula, you can calculate directly. That's it. Clear. Next, case 3. Very important. Value of a share on the base of EPS. Value of share on the base of EPS. For the year ending 31st March 2017, the company has earned 13671 lakhs as a profit after tax, which can be considered to be the normal for the company. Okay. So average EPS for a fully paid up share of rupees 10 rupees of a company in the same industry is 2, which means average EPS for fully paid up share of rupees 10 rupees paid up value. Okay, for 10 rupees paid up value of a share. Okay, the point is saying that the EPS is 2. For 10 rupees fully paid up share for 10 rupees share value. For 10 rupees share, the EPS is 2 rupees in the similar industry. That is the point they are saying that average EPS for a fully paid up share of 10 rupees of a company. The average EPS how much? In the similar industry is 2. For 10 rupees face value of a share. 10 rupees face value ఉన్న దానికి 2 rupees average EPS అంట ఇండస్ట్రీలో నార్మల్గా. ఓకేనా? క్లియర్. దట్స్ ఫర్ తెలుగు స్టూడెంట్స్. ఓకే. So still so many Telugu students are asking about actually so Telugu students are always comfortable in Telugu only because it's a mother language, right? Yeah, I know that situation. So that's why once I'm done with it, I'm going to start in Telugu also. No need to worry. For Telugu students, if you want any, concepts, want to learn in Telugu, listen in Telugu only, you can listen later. Okay, na? For the time you have to learn in English only. Okay, because we have a lot of English students actually, so they don't know Telugu. Okay, clear. And we have started already cost study classes as well as now BV start has to be started. So there's no time for us, so that's why. Clear? So this is the third question. What is the value of a share, right? So before going to that, the question in the question given that what is that earnings given, profit after tax is given. We know the number of shares and also EPS for 10 rupees EPS, 10 rupees face value of a share, average EPS is 2. This is information in the given question. So first of all, you need to calculate earnings per rupee of share capital. We already know about it. I have said the formula, right? Earnings after tax by paid up capital, paid up share capital. Correct or not? Paid up share capital. What is earnings after tax? 1371 given. What is paid up capital? Go to the question. So 1800, 720. How much? 2700 plus. How much last one? 750. 750. Paid up value. Please, anybody?
Yes, sir.
I want paid up value fast. Paid up value, not full value. Okay, see. 1800 here, right? Here we need to take 720 or not? 720 only, not 90, because this is only the paid up value, paid up share capital. That is the point, because 8 rupees only paid up here. Correct or not? Yes. And 750 paid up total. 1800 plus 720 plus 750. 3270, right? This is the actual paid up share capital. So we can calculate. What is that? Earnings per rupee of share capital. Earnings per share how much? 1371 divided by number of shares. 345. Correct or not? But earnings per rupee is different here because the paid up value is different. Correct or not? Yes. Everyone clear about it? Okay now. Yes, this is earning per rupee of a share capital. For 10 rupees fully paid up share, what are the earnings? Earnings for fully paid up shares of rupees 10 is how much? This is per rupee. I want for 10 rupees. So into 10. 4.19. For 10 rupees face value, 8 rupees paid up, we need to take a paid up value. So this is per rupee, I want for 8 rupees, 3.35. This is per 1 rupee, I want for 5 rupees, 2.095. Simple. Earnings, I'm talking about earnings only, not value. Value per share is different, right? Correct or not? So this is just only the earnings per rupee. Per share. Per rupee per share. 4.19, 3.35, 2.095. Is it clear? So now I want a value per share. Value per share. See, value for fully paid up share of rupees 10 rupees. Actually, fully paid up value. Earnings how much? 4.19 is the earnings. 4.19 is the earnings, right? Okay. So the point is saying that for 10 rupees face value, 2 rupees is the average EPS. Correct? Then how much for 4.19? Correct or not? 10 rupees 2. I want 4.19. I want for 4.19. How much is the EPS? Correct or not? You want EPS or a value, sir? Please tell me. You want EPS or a you want EPS or value? You want value, sir. Nothing but this one you need. Are you getting my point? You don't want any EPS here. We already know about EPS. Already we have calculated. This is only the EPS. Nothing but 4.19 is the EPS actually. For 10 rupees face value, 2 rupees is the EPS. When 4.19 is the EPS, then what is the value? That is the question. Not reverse case. Please think properly. Are you getting my point? For 10 rupees face value, 2 rupees EPS. 4.19 is the only the EPS only here. Per rupee. This is also per rupee. For 10 rupees share value, 2 rupees is the EPS. Here 4.19 is EPS, then what is the value? So 10 into 4.19 divided by 2. How much? $20.95. Yes. In the second case, same. For 10 rupees, 2 rupees EPS. But I want for 3.35. 16.75. Next, for 10 rupees, 2 rupees is EPS. So now the EPS is 2.095. How much? 10.475. Yes. Some students may got about the doubt, sir, this is 5 rupees paid up, this is 10 rupees. How you calculated this? So some students may got this doubt. Sir, this earnings per rupee is for 5 rupees only. That is 2.095. is the earnings per rupee. This is also earnings per rupee. Okay, now earnings per rupee only. Earnings per share or not? Are you getting my point? In that case, see, for 10 rupees face value, 2 rupees is EPS. For 10 rupees, 2 rupees is EPS. I'm equivalent to that simply. Okay, so I got 2.095 is the EPS. Earnings per share only. So then you can calculate easily. How much? 10 point something. 10.475. That is the value per share. Are you getting my point? Okay, now value per share of rupees 5 rupees fully paid up is 10.475. So I will tell one more time for the third point. I think first 2 points everyone clear. Third point is very important. First of all, you need to calculate earnings per rupee. Earnings per rupee actually, because we cannot calculate the earning per share directly, because earning per share calculation we need to take number of shares. Correct or not? So we will take total shares, whether it's fully paid up or not. But I want value per rupee actually. I mean value per share actually. But that's why I am taking earning per rupee, because I am taking like this just because of different class of shares. Otherwise I can take directly the EPS, I can calculate. But I am taking earnings per rupee. So profit by paid up share capital. How much? 320, 3270. Correct? Yes, 0.419. Correct, earnings per rupee. I want for 10 rupees share. Earnings only for 10 rupees. This is per rupee. For 10 rupees, 10 into 0.419. For 8 rupees, 8 into 0.419. For 5 rupees, 5 into 0.419. Okay, now this is per share. We got some value This is earnings per share. Earnings per share. I want what is that value? For 10 rupees face value, 2 rupees is EPS. If this is the EPS, then what is the value? 10 into we got first value how much something 20 point something divided by 2 you got value. Correct or not? Yes. Sorry, point 4 or 4.1 right? So 10 into 4.1 divided by 2. Yes, this is the simple way of a calculation. So in your institute book, there are a lot of mistakes in this chapter. Please don't follow that. Don't follow that. That's it. Perfect answers I have given in my material. Okay, now is it clear, everyone? Yes. Clear, guys? This is question number 1. Very important. Okay, guys. Question number. We are done with question number. So actually, we don't have a lot of time. Actually, the uploading time is too much. So my suggestion is go to CFR Marathon 2.0 valuation of shares part 2, part 1 only. It is available. Go to Marathon 2.0. Their valuation of shares we discussed 3 problems, and in this one more question, 2 questions we have discussed here. Okay, that is more than enough for valuation of shares. And for theory also, whatever the theory we have discussed there, go through that only. Okay, and extra theory I will discuss here. Valuation, value added statement and the economic value added. These topics will be uploaded in this marathon. Okay, now ready? Clear? Okay, thank you.
Hi guys, good morning to all. So our next topic is EVA, economic value added. So it is very simple topic, examination point of view, very important. Almost actually in previous exam for new syllabus students they got 5 marks from this topic. Okay, simple. For economic value added means simply it's an economic profit. It is an economic profit. Okay, now so the main aim of this economic value EVA is to calculate the true economic profit of the company. For what purpose, sir? The purpose is to calculate the true economic profit. True economic profit of the company, that is nothing but economic value added. Generally, EVA is used to measure the value of a company generates from funds invested in it. Okay, whatever the suppose example I invested 10 crores in the business I invested. So what the company generated, what the value of the company generated, for that purpose EVA is used. EVA is used to measure the value of the company generates from funds invested in it. For that purpose EVA is used. Simply the calculation of EVA is NOPAT minus capital employed into weighted average cost of a capital. This is the formula, simple formula. Okay, now clear? First of all, what is NOPAT? What is NOPAT? Net operating profit after tax, which means net operating profit after tax. Okay, in symbolic terms, EBIT into 1 minus T. The formula is EBIT means earning before interest and tax into 1 minus T. Okay, now 1 minus T means tax. T means tax. That is nothing but net operating profit after tax. Simply through calc you can calculate directly. Suppose example EBIT 1 lakh, tax rate 30%. So the NOPAT will be how much? Simply 1 lakh minus 30%. Simple calculation. 1 lakh minus 30%. So simply in calculation EBIT, please take EBIT value minus tax rate. You will get NOPAT. Simple calculation. Next, weighted average cost of a capital means WEKE plus WDKD. WEKE means weight of equity into cost of equity. KE means cost of equity. WD means weight for the debt, and KD means cost of a debt. I think this formula, I think you learned in CMA Inter FM Financial Management Cost of a Capital topic. In cost of a capital topic, I think everyone knows about this formula. So KE means cost of equity, KD means cost of debt. So debt always after tax only. Please remind this point. Please don't forget. This is very important. Debt after tax, always after tax only. KD into 1 minus T. Suppose example, uh, cost of a debt is 10 percentage, tax is 30 percentage. So the KD will be how much? 10 minus 30 percentage. Nothing but how much? Sorry, 3 percentage. So for example, 30 means 10 minus 30 how much? 7 percentage. So 7% is the KD. So that is the calculation. So please don't forget about that. Cost of a debt means always after tax only. Always after tax only. Even if in the given question they may give before tax. So please reduce the tax from it. That's the important point. Please don't forget about that. Okay, na? Next, capital employed means equity plus debt. Equity includes here other equity also, nothing but reserves and surplus. Equity plus debt, that is nothing but capital employed. Okay, na? Clear? And this is the important point. In previous exam, in last attempt, question framed with this formula only, because in SFM everyone knows about this formula, CAPM model. CAPM model. Okay, na? Capital asset pricing model. Through this model, the cost of a capital formula is RF plus RM minus RF into beta. RF means risk-free rate. Risk-free rate plus RM means market rate. RF means again risk-free rate. Beta means risk. Okay, na. Beta means risk. Okay. So formula is RF plus RM minus RF into beta. So RM minus RF combinedly, which means it's a premium, market premium, which is market premium. Okay, now RM minus RF means market premium, RM means market return, RF means risk free return, beta means risk. Yeah, then you will get cost of equity. So, suppose example, company beta is 1.4, market return is 14%, RF equal to 10%, then expected return of a company equal to expected return, nothing but KE means expected return or cost of equity. How much? RF plus RM minus RF into beta. So 10 plus 14 minus 10 into 1.4, you will get 15.6%. That is the cost of equity. This cost of equity will use in weighted average cost of capital KE. For this calculation, we calculated this. Okay, na? For calculation of cost of overall cost of a capital, nothing but weighted average cost of a capital, we want KE, right? For KE calculation, this is the formula under CAPM model. So in last attempt, institute giving this question only, and also set 2 paper also, mock test paper also, they have given this question. Okay, clear? RF minus RF means risk premium, RF means risk free risk data, RM means market data. Okay, na? This is the formula. And one more point, K equal to D1 by P naught. I think everyone knows about this formula also. K equal to D1 by P naught plus G. Correct or not? So please check once again your SFM formulas also for calculation of cost of equities. I think you will find this in portfolio management, right? CFA model, correct or not? Okay, na. So find there. Okay, na. Or go to CMA Inter FM material. You will find the cost of a capital. Okay, you will find some formulas. Okay, na. Clear? Okay. Next, calculation of NOPAT. How to calculate NOPAT? Simple. So, in example, sales 5,000, operating expenses 2,900, depreciation 300. You will get EB8 minus tax rate 540. You will get a NOPAT. So here, no need to reduce the interest value. No need to reduce the interest value from EB8. Okay, na? This is the calculation for NOPAT. Simple example. Next, calculation of weighted average cost of a capital. Suppose example, if the equity is 500, retained earnings is 400, debentures is 600. Okay, now equity value is 500, retained earnings is 400, debentures is 600. Now you should calculate the proportionate. For calculating weighted average cost of a capital, first of all, you have to calculate the proportion. So total 900, 1500, right? So please calculate the percentage. 500 by 1500, 1 by 3. So 0.33. Here 0.27, zero point 0.4. This is the proportion. Total one. 500 by 1500, 0.33. 400 by 1500, 0.27. 600 by 1500, 0.4. This is the proportion. Next, weights. What's the weights? Simple, sir. This is the weights you should calculate. Nothing but this is the KE. For retained earnings also we will use KE only, cost of equity only. Okay, now cost of equity only for retained earnings also, because retained earnings also will available to equity shareholders, right? So that's why for that purpose, for that also you will use a cost of equity only, and for debentures you should use a cost of a debt after tax. Please don't forget about that point. Please don't forget. So minus 30%, 8 minus 30%, you will get 5.6. This is the after tax, cost of debt after tax. Okay, now then the product of A and B. Okay, now you will get some value. Then this is the cost of a overall cost of a capital. Nothing but weighted average cost of capital. KY. Okay, now. Okay, now this is weighted average cost of a capital calculation, general calculation. For example. Okay, this is example number 3. This is the exam question. I think almost 5 to 7 marks. I don't know exactly. 5 or 7 marks. See here, very simple question. Share capital, reserves and surplus. Next, long term debt and creditors. Fixed assets in inventory. Next, current assets. For investments, current assets. Additional information. PBIT, profit before interest and tax 1000. Interest 20. Tax 35.875%. Risk free rate at 10%. Market rate 15%. Beta 1.4. Calculate EVA. Simple కాదు, చేయగలరా లేదా? EVA formula. What is the formula? NOPAT minus capital employed into weighted average cost of a capital. This is the main formula, right? NOPAT minus NOPAT minus capital employed into weighted average cost of a capital. Okay, na? Correct? Yes. So go to solution. First of all, what you have to find out? NOPAT. So NOPAT already we already know, no sir. Just we have PB8, nothing but EB8. So profit before interest and tax minus tax rate. So 1000 minus tax rate how much? 35.875%. You will get NOPAT. So go to NOPAT. This is the NOPAT calculation. EB8 into 1 minus tax. Simply 1000 minus 35.875%. You will get 6641.25. This is the NOPAT value. Sir, this is the exam question, sir. Please don't ignore this video. Okay, na? So I'm doing lecture for actual regular students only, but I'm uploading in YouTube also, so you also can watch. Okay. So NOPAT already completed. Next, what is that? Sorry. Formula: capital employed into weighted average cost of a capital. Capital employed into weighted average cost of a capital. Okay. So see here. This is the calculation for weighted average cost of a capital. So this is the format. So please remember this format: particulars, amount, proportion, weights, A into B, nothing but proportion into weights. This is the format. Simple. Normal కూడా చేయొచ్చు, బట్ మనం ప్రొఫార్మా లాగా చేసాం అంతే. You can do normal direct calculation also, but please remember this format. It will be more helpful, more understandable way also. Okay, so please take all the capital employed figures, nothing but equity, retained earnings, debentures. equity, retainings, debentures. 1000, 2200, 1000, 2200. So next, the total amount is 3200, right? So take the proportionate value. So 1000 by 3200, 2000 by 3200, 200 by 3200. You will get the proportion. Okay. Now you are going to calculate the weights. Now you are going to calculate the weights. Weights means nothing but a simple. Nothing but this. We can say these are the weights. This is the cost of a capital, right? Cost of a whether it is equity or a debt. Okay, na? So first of all, you should calculate this cost of a capital, cost of equity. How to calculate cost of equity? By using this information, we have RF. Next, market rate, beta also. Sorry, beta. Yes, we have RF, market rate, and beta also. So now by using the formula CAPM model, you can calculate KE, right? KE equal to RF plus RM minus RF into beta. How much? 17%, right? 17%. You can calculate. Please calculate. Okay. This is the KE as per CAPM model. So 17% here for retainings also we will use a 17% only. Next, KD. How to calculate KD? Simple. Interest minus simply interest minus interest minus tax rate. How to calculate, sir? Interest minus tax rate. Interest rate how much? Interest rate how much? So go to question. This is the 20's interest amount. Debt how much? 200. So long term debt how much? 200. So 20 by 200 how much? How much? The 10%? Okay, 10% is the KD. KD is the 10%, but before tax. We want after tax, right? So 10% minus how much? 35 point something. 10 minus 35.875 percentage. You will get 6.4125 percent. So that is the debenture value. Okay, na correct. Debenture KD. So now please product of these two. You will get these values. The ultimate value is 16.34. This is K. Weighted average cost of a capital. Weighted average cost of a capital. So now we have no PAT. Next, capital employed also we already know about that. And also cost of a overall cost of a capital. Weighted average cost of a capital we already know about this. So just substitute in the formula EVA, you will get EVA value. So here with the calculation of EVA, no PAT minus capital employed into weighted average cost of a capital. So 641.25 minus 3200 into how much? 16.34 percentage. So ultimately we will get EVA value. It's very simple calculation. Economic value added. This is the exam question. And one more point, please find that. So please go to operating leverages chapter. Just remember the formulas for financial leverage, operating leverage. Okay, now. So generally financial leverage formula is EBIT minus EBT. Just for the purpose of calculation of EBIT. Sometimes we don't know about the value of EBIT also. Based on the given information, you should calculate. Okay, we don't know the question may come or not. We don't know. But please go to leverage chapter. Please just remember that operating leverages formula and financial leverage and combined leverage. Okay, now are you getting my points? Okay, now simple formula, sir. For operating leverage, the formula is contribution by EBIT. For financial leverage, EBIT by EBT. For combined leverage, nothing but contribution by EBT. Simple. These are the three formulas. By using this, actually in question, I think, for example, the operating leverage is 1.5. The contribution is 2000. then you should calculate the EBIT based on the given information. So please remind these formulas also for calculation of EBIT. That's it. That is more than enough for exams. Okay now, clear? And the next topic is very simple topic and last topic, market value added. Simple sir. Market value added is the difference between the current total market value and the capital contributed by investors, equity and debt holders. Equity and debt holders. That is a market. That is a market value added. Simply the difference between. Can you please repeat? Current total market value and the capital contributed by the investors. Whether it is equity and debt also. Next, it is typically used for companies that are larger and publicly traded. So, generally, it is used for companies that are larger and publicly traded. So, I think you may find in stock market trading. So, many companies you may find like a Reliance company. It's a large company. So, it will trade in the stock market, right? Yes or no? Yes. In that case, they will use this market value added calculation. And it is a wealth metric, but EV is a performance metric. Generally, economic value added is a performance metric, but it is a wealth metric. Wealth metric, and it measures the surplus value of the company has generated in a reflection of its future performance. But sir, it measures the surplus value of the company has generated in reflection of its future performance. Okay, now what it measures the surplus value of the company has generated. So surplus means so for example, profit like profit. Okay, it measures the surplus value of the company. For that purpose, market value is useful. And in exam, the difference between EVA and MVA may be asked. So uh, simply write the all the points separately. So please don't no need to differentiate with a box or a table. You can write separately also. Okay, na? So this is market value added. Very simple. So we can expect this exam for 4 months. Okay, na? So please don't ignore this video. Very important. Examination point of view. Very important. Okay, na? Thank you. Thank you so much. Hi guys. Good morning to all. So welcome to CFR classes. So today our next topic, Ind AS 103, business combinations. Okay, now what is the topic name? Business combinations. Very simple topic. Examination point of view. Very important. Almost 20 to 25 marks weightage from this topic. Are you getting my point? So business combinations. Okay, let us start with the background of this topic. So first of all, what is the background of this topic? Simple, sir. Simple. Generally, we have a accounting standard 14 previously. Okay, accounting standard 14, nothing but amalgamation. What's the name of the standard? Amalgamation. AS 14. Now, in Ind AS, the standard number is 103. Business combinations. Previously, we have a different types of wordings like amalgamation, merger, demerger, absorption. Okay, now so like this we have a different types of our names. Okay, now as per accounting standard 14. Now you are final students, right? So you have Ind AS. So as per Ind AS 103, the topic is same, but the wording is only one. That is nothing but business combinations. For every name, for all the names, they are using only one name as per Ind AS 103. That is business combinations. Are you getting my point? Okay. So now the single name is business combination. Or one more word also there. That is nothing but business combination under common control. So we will discuss it later. Ultimately, as per Ind AS 103, they were using only one name. What is that, sir? Business combination. Simple. Business combination. Even if it is a merger or an amalgamation or an absorption, whatever may be, we will use only one word. That is nothing but business combinations. Okay, now. First of all, before going to what is business combination, we should know why this business combination, why this standard comes into existence. Simple, sir. Simple. Very simple standard. So, for example, Naga Chaitanya. Okay. Naga Chaitanya, hero. Okay. Samantha. Okay. Both were actors. Correcta? In Telugu cinema industry. Telugu movie industry. He is a hero. She is the heroine. I'm talking about before their marriage. Okay. I'm talking about before their marriage. Okay. So Naga Chaitanya is growing slowly. Okay, well his graph is well and good, and Samantha is growing highly. Her graph is very high. Correcta? Yes. So both were in love and get married. Correcta? Yes. Correct or not? Okay. So here the thing is, he's growing alone. She's also growing alone. Both wants to grow by single. So nothing but I'm talking like uh, ఒక్కటే అన్నట్టు ఓకేనా I'm unable to say that particular word ఓకేనా so they want to grow together. Okay, they want to grow together, so that's why they are married. Okay, Samantha acquired Naga Chaitanya. Samantha acquired Naga Chaitanya. Correct? Yes. Correct or not? Yes. So, for steady growth, first objective is for steady growth, this business combination will be helpful. So, for the example, Vada, this is our accounting point of view. Vada idea. So, both were merged and they form VA. Correct? Correct or not? Vada and idea both were joined together and form a VA. Correct or not? So this is the telecommunication, this is also telecommunication, both were amalgamated, they form new company, VA company. Correct? Yes. For what purpose, sir? The first point is growth, nothing but their expansion, market expansion. Okay, now nothing but okay, so the first point is growth or market expansion. So they want to expand their business. So that's why they have joined. Okay, now are you getting my point? So generally in local areas, what are signals will not come. I think some students may know that, but idea may come. So that's why if they both are joined, so their market will increases, right? Market will increases. So for that purpose, generally business combination will takes place. And one more point is to reduce the competition. So obviously competition will reduce because we are acquiring one same similar company. So that's why obviously the competition will get reduced. So reduce the immense competition. Correct? Reduce the immense competition. For generally these purposes, business combinations will takes place. Business combination. Okay, are you getting my point? So A limited, B limited together join to form a AB limited. This is the new company. So because of first point is for steady growth and also reduce the immense competition. So to reduce their competition. For this purpose, business combinations will takes place. That's it. Are you getting clarity? I hope you are getting complete clarity about this background. Clear? Correct or not? So go to chapter number 12, business combinations. Okay, see here. So introduction. In today's this topic is very interesting. It will become more interesting. Okay, na? So please listen carefully. In today's global business environment, companies both new and existing face immense competition for their survival. So now we have different types of companies for particular product or particular consumable. Okay, so there are different types of companies. We have a lot of competition. So for example, if you are taking a telecommunication, so Geo is the top. Present Geo is in very top, correct? Next Airtel. So these are all those telecommunication companies have a immense competition, very high competition, correct or not? So for that purpose, they want to reduce their competition and also for steady growth. So they were so for that purpose, business combination will take place. That's the introduction. So in Ind AS 103, two terms will be used. What is that? One is business combination. Second one is business combination under common control. I already discussed about this point. Okay, the terms merger, absorption, amalgamation, demerger, external reconstruction, reverse merger are accommodated with about two terms. Actually, there are different types of words. Everything will be included in business combinations. Okay, na? I already discussed. Okay, na? As per accounting standpoint, there are different types of words. Everything will be included in this about two terms. What is it? Merger, absorption, amalgamation, demerger, external reconstruction, reverse merger. So for every topic we will discuss later. Okay, for every topic we have a concept as well as a problems also. We will discuss it. So you have to remember just one point here. What is that? These are all included in this one. Nothing but business combinations as well as business combination the common control. I think you know about the common control because I have a control in A limited and also I have a control in B limited also. Okay, now are you getting my point? So both are under my control only. Correct or not? Or so for example, I have a 90% holding in A limited and a 70% holding in B limited. So now A limited acquiring B limited. A limited acquiring. Okay, now clear? Okay, next. Now go to concept Ind AS 103. Actually, in all silver students, they have accounting standard. AS 14 questions also will come in exam. But for you, completely Ind AS. Completely Ind AS. Now, present market, most of the companies comes under Ind AS limits only. So in I think in our first topic we have discussed about the Ind AS applicability, right? So most of the companies under that particular limits threshold. So that's why institute also focusing on Ind AS only. Correct? Okay. Okay. So come to business combination definition. Simple, sir. First of all, business combination. Nothing but a symbol. So for example, company A limited wants to acquire B limited. So this is nothing but one type of a transaction, correct? Yes. So that's why business combination is a transaction. Business combination is a transaction or an event in which acquirer obtains control of one or more businesses. Who is acquirer? Here, A limited is acquiring B limited, right? So that's why A limited is the acquirer. Here, B limited is known as acquiree. What is that? Acquiree. So the definition is saying that is a transaction or an event in which acquirer obtains control of one or more businesses. Acquirer obtains the control of one or more businesses. Here, A Limited is the acquirer. He obtaining control. So we don't know about control. Generally, more than 50%, more than 50% holding. So generally, we can say it's a control. But we have a control definition separately. Okay, now. So of one or more businesses, not only one business, one or more business. So A Limited wants to acquire C Limited also. A Limited can acquire D Limited also. Okay now. So in which acquirer obtains the control over one or more businesses. This is the business combination. Are you getting my point? Business combination is a transaction or an event in which an acquirer obtains the control of one or more businesses. That is the definition for business combination. We have to learn the definitions of acquirer, control, and business also. We have three different types of definitions. We have to discuss later. We will discuss later. Okay, now this is the general definition for business combination. Can you repeat this? Business combination is a transaction or an event in which acquirer obtains the control of one or more businesses. Correct? Yes. Next, this standard applies to a transaction or event that meets the definition of business combination. The transaction which meets the definition of business combination. For that only this standard will apply. If it does not meet the definition of a business combination, this standard will not apply. That is the point. Are you getting? Yes. So this standard does not apply to formation of a joint venture. For joint venture, standard will not apply. For true or false or fill in the blanks or MCQs, it is very very important. And second one is asset acquisition. If you are acquiring some assets from particular company, that is not a business combination. That is asset acquisition. If you want to acquire a business, you have to acquire complete total business. Okay, if you acquire some assets or a few assets, that will not comes under this standard. Okay, as per Ind AS 103, you have to acquire complete business. Then only it will comes under business combination. Otherwise, it will not apply. So the first one is formation of a joint venture. Second one is asset acquisition. Okay, now. So generally, you know about the joint venture for particular temporary partnership for particular purpose. Two or more persons are joined together to form a joint venture. Those are known as joint ventures. Nothing but co-ventures, right? Correct? Correct or not? Joint venture means what is that, sir? It is nothing but partnership only, but they are entered for particular purpose. Suppose example, they want to construct a dam. Okay, A, B, C come together, join to form a temporary partnership. Nothing but joint venture. For completion, once completion of a venture, they will disperse. The agreement will get cancelled. That is nothing but joint venture, right? So joint venture is different, partnership different. Partnership is will continue over a period of time, but joint venture, once the project is completed, they will get dispersed. The agreement will get cancelled. Correct? Yes. Nothing but temporary partnership. Are you getting? So the standard will not apply. Are you getting? Okay. So please remind this word acquisition method. So generally, as per accounting standard 14, we have two different types of a method. One is purchase method. Second one is pooling interest method. What is it? One is purchase method. Second one is pooling interest method. Are you getting my point? As per accounting standard, there are two methods. One is purchase method, second one is pooling interest method. Actually, as per accounting standard 14, standard name is amalgamation, right? So amalgamation also two types generally. amalgamation in the nature of purchase. First one is amalgamation in the nature of purchase. Second one is amalgamation in the nature of merger. There are two types. For purchase method, they will use the purchase method. For merger, they will use the pooling interest method. Okay, this is as per accounting standard 14, but we are in business combination 103. Ind AS 103, right? So for this, the method is acquisition method. For MCQ purpose also, it is very important. Acquisition method. Okay, now under Ind AS 103, see here the definition again we're discussing here. A business combination is a transaction or event in which acquirer obtains the control of one or more business. Correct? Huh? Okay. So come to next. So I think the points are again repeated, right? To minimize the competition. Okay. So see, a business combination can be in the form of merger and acquisition. It may be in the form of merger as well as acquisition also. Correct? Huh? Yes. Merger means, so for example, A Limited joined in B Limited, or A Limited acquiring B Limited. So there are different types of business combinations in this concept. We will discuss it later. Okay, na? So accounting standard 14 as well as Ind AS 103, both are same or different. So obviously substantially different, not same, sir. Almost different. That means almost different. Substantially different. Ind AS 103 lays down the accounting principles for business combination, not for asset combination. We are already discussed about this point. Only asset combination is not applied. Only business combination only will apply. So as per accounting standard 14, accounting asset acquisition also it comes under AS 14, but it is not under Ind AS 103. That's it. That's the main difference. Okay, we have an important question also in exam. Differences between accounting standard 14 and Ind AS 103. Okay, so we have that question. We will discuss it later. I think. Okay, this is the difference. We will discuss later. Just wait. Next. So come to the definition. We have a definitions of business, control, and acquire. Once we are done with the three definitions, we will go to accounting. That's the main for us. Okay, now. Simple, sir. Very simple. Examination point of view, this is not important, but still we have to discuss. That's it. Business, control, acquire. First of all, what is business? Simple group of people coming together. Correct? Huh? Simple, sir. Business means we have three terms. One is input, process, output. Input plus process equal to output. That is nothing but business. See here. A business consists of inputs and processes applied to those inputs that have ability to create outputs. So, for example, if you want to start a manufacturing company of mobiles, okay, mobiles. So, for example, okay, clear? Sorry. If you want to manufacture mobile, what are the requirements? Can you please? Raw materials, nothing but something motherboard, RAM, okay, something board is there, right? I don't know the exact names of a mobile because we are not a mobile repairs, okay. We will not do any mobile repairs, right? And I know about camera and glass, okay na? So there are different types of raw materials. So without raw materials we can we manufacture? No, we cannot. Correct? So those are the inputs. And labor also required. Correct? Yes. Correct or not? Sorry. Equipment also required. Some equipment, plant and machinery. So some requirements may be there. Correct? Like a plant and machinery. We don't know exactly what are the requirements they are using. but some raw material is required, right? So that is known as simply inputs. Okay, nothing but raw material, plant and machinery and equipment. These are comes under inputs, and we have to process it. Process it. For processing, what do you want? The management, labor. So management have some policies and procedures. So without management, they will do anything? No. Say sir, no. No sir, because management is compulsory, and labor also required to process it. Ultimately they will get finished good. Correct? Okay, such finished good will be sold in the market. Sell in the market, they will get money, whether it may be profits or losses. Correct or not? Profits or losses. So come to definition. Input: any economic resource that creates or has ability to create outputs when one or more processes are applied to it. We have input, we are applying some process for it. Okay, we are applying some processes for it, we will get output. So the point is saying that, okay, clear? So we are done with the input definition. Next, symbol: process. What is it, sir? Process. Simply business means input plus process equal to output. Correct? Yes, input means simply raw materials, equipment. Correct or not? So these are the inputs. So please read the definition again. Examination point of view, the business definition is not important. So in examination, they will not ask any question related to business. Okay. So no need to worry, no need to study also. Just for the sake of information, I am telling that. Simple. Clear? So business means simply input plus process equal to input. Sorry, output. Input means any economic resource that creates. Just wait, ma. Just wait. Okay. So any economic resource that creates or has the ability to create outputs when one or more processes are applied to it. Correct? So that is the definition for inputs. So we have to process that input, we will get output. What are the inputs we are given? That is known as, what are the economic resources? What it will create generally? What is your required, sir? What is the requirement generally? Raw materials is the requirement. Suppose example, if you want to uh, if you want to manufacture a particular product or finished good, what are the requirements generally? Obviously, raw material is the main requirement, correct? So yes, next, process. We have some protocols, we have some systems, we have some policies and procedures, management. So everything involved in a process. So any system, please read that point. Process. Any system, standard protocol or convention or a rule that when applied to an input or inputs creates or has the ability to create output. So that is known as process. Whatever the systems or policies, procedures, rules and regulations, whatever we are using to get outputs is known as simply process. Correct? Yes. So then what is the output? What is the outputs are generally? Simple. The output of the results of outputs, the results of inputs and process applied to those inputs that provide or have ability to provide a return in the form of dividends, lower cost or economic benefits directly to investors or the owners, members or participants. So for example, you have invested in a particular entity, you will get a return on that. Correct? Say sir, no. Yes, nothing but in the form of dividend. And it will be lower cost and other economic benefits directly to the investors or other owners or members or participants. Then it is known as output. Correct? Simply, organization will get profits. Correct? So that is known as simply output. Result is the output. What is the result? For what result, sir? Result of input and process. So we have processed the input, we will get output. So obviously the result of input and process is known as output. Okay, it may be in the form of written in the form of dividends. Okay, now, or it will be lower cost or other economic benefits to the investors or other owners and members or participants. That's it. Okay, now. So simply this is the definition for business. Input plus process equal to output. That's it. Okay, now this is the definition for business. Next, examination point of view, important definition that is known as control. 4 marks question actually in one attempt. So institute asked this question. So the definition for control is not defined in Ind AS 103. It is defined under Ind AS 110. Nothing but consolidated financial statements. In business combination topic, the definition of control is not discussed. So it was discussed in Ind AS 110. Okay, now. So an investor controls, as per Ind AS 110, an investor controls an investee if and only if the investor has all the following. So who should have who should have a control, sir? Simply investor, nothing but acquirer. Acquirer controls an acquiree, nothing but investor controls an investee. If all the conditions are following, what is it? First, power over the investee. Obviously, acquirer, nothing but investor should have a power. Power means simply control, nothing but. So, when they will get powers, are generally, obviously, if you have a 51% or more shareholding, automatically you will get some control. Next, exposure or right to variable returns in the investee. Suppose example, A limited is the investor, B limited is the investee. Okay, now you have a right to variable returns in the investee. Variable means change. It is in your hands only. Nothing but investor hands. Investor, you have a control over investee. You can change. You can variable the returns in the investee. Everything depends on you only, right? Obviously, if you got more profits, you will give more return. Otherwise, low return. So you have the ability to use its power over the investee to affect the amount of investors. He have a ability to affect the amount of investors also, because he have a power over the investor, right? By using its power, he can affect the amount of investors. So for example, he have 70% holding, completely have a control. Okay, he wants to issue for more number of shares to get 80% of a shareholding. So he can affect the amount of investors. Correct or not? Yes. Because when we are issuing new shares, he is only purchasing that. So obviously the other investors proportion will be changed. Correct? Yes. That's it. So we have a ability to affect the amount of investors. That's it. This is the point. Definition for control. Can you please repeat the 3 points? First point, power over the investee. Next, exposure or right to variable returns in the investee. Next, he has an ability to use its power over the investee to affect the amount of investors. Correct? Yes, that's it. Next, we want definition about acquirer, right? Acquirer. Okay, we will discuss it. Okay, we will discuss here. So, this is the basic background of this topic. Next, accounting for business combinations. Now, this is the examination point of important. You have to account that business combination. Business combination is a transaction or an event, correct? Yes, you have to account it. You have to account it. Is that clear? Just wait. Okay, let's come to accounting for business combinations. So examination point of view, very important. See here, all the business combinations shall be accounted by applying dash method, acquisition method. What is it, sir? Acquisition method. That is nothing but purchase method only. But we will use the word acquisition method. We already discussed about this point. Okay. So in accounting for business combinations, we have a totally 6 steps. How many steps? 6 steps. If you are done with these all these 6 steps, so the accounting for business combination will become very easy. Okay. So come to point. Suppose example, everyone knows about Samantha, Sam, and Naga Chaitanya. Okay, fans unnara ఎవరన్నా? Okay, anybody? Okay, see here, simple. So, business combinations. Simply, Samantha wants to acquire Naga Chaitanya. Samantha wants to acquire Naga Chaitanya. Okay. Who is acquirer? Samantha is the acquirer. Naga Chaitanya is the acquiring. Correcta? Yes. Samantha wants to acquire Naga Chaitanya. Okay. Clear? Simple. For acquiring Naga Chaitanya, Samantha has to pay some consideration, nothing but dowry. Correcta? Dowry has to be given by Samantha. Suppose example 10 crores. Example, for example, or 100 crores. Okay. Samantha has to give 100 crores of a dowry to Naga Chaitanya. Correcta? Okay, na? Okay. Sir, 100 crores will be given based on Naga Chaitanya assets, correct? Yes, because he is a almost thousands of a crores. Nagarjuna have a thousands of a crores, so or hundreds of a crores. So Samantha at least she has to give 100 crores of a dowry, correct? Suppose example the marriage date. The marriage date is suppose example already done, kada? Okay. 1/5/2018. Suppose example this is the marriage date. Marriage date. Okay now. And 1/1/2018 is the engagement date. For example, just this is engagement date, this is the marriage date. Are you getting my point? Simple. In case of business combination, we have a 6 steps, right? The step number one is identify the acquirer. Who is the acquirer here? Yes, Samantha is the acquirer. That's the first point, first step. Second step is determination of acquisition date. So here we have two different dates. Which is the acquisition date? On which date Samantha gets control over Naga Chaitanya? That date is known as acquisition date. Obviously, Samantha will get control over Naga Chaitanya on marriage date only. Once marriage gets done, she will get a complete control over Naga Chaitanya. Correct? Yes. So 1/5/2018 is the acquisition date. For acquiring Naga Chaitanya, Samantha has to give some consideration. Correct? Nothing but dowry. Such dowry is known as purchase consideration. She's acquiring Naga Chaitanya. For that purpose, she has to pay some money. That is known as purchase consideration. That is the third step. That is the third step. Okay. So this purchase consideration will be based on what's her Naga Chaitanya's net assets. Obviously based on his suppose example, suppose if you want to marry some village person, so his assets is overall 20 to 30 lakhs only, you have to give 5 to 10 lakhs or 6 to 7 lakhs. That is the uh, dowry amount should be based on his net assets. His net assets is Nagachitran net assets is more than 100 crores. Obviously, she has to give 100 crores of a dowry. So nothing but this dowry depends on his net assets. Correct? Yes, obviously. Suppose example, the Nagachitanya net assets will be 120 crores. Assume that. But Samantha is giving 100 crores only. Correct? So Samantha giving 100 crores, but the net assets of Nagachitanya is 120 crores. In net assets there we have a different types of assets, some assets in the form of buildings or a land or a gold. So there are different types, sir. Obviously when you are giving a dowry to your future husband, it includes gold, land, flats, cash. It may be in the form of cash also, correct? Yes, sir. Yes. So based on net assets of the acquiree, nothing but Naga Chaitanya, Samantha has to give consideration. Correct. So for that purpose, you have to calculate the net assets value also. Step number 4. Net assets means total assets minus outside liabilities. Total assets minus outside liabilities. That is nothing but what is it, sir? Enter the net assets, identifiable net assets. On which date, sir? Which date? That is the main important point. So please remind these 2 points in case of business combination. That is fair value. Second one is acquisition date. Everything should be on acquisition date only because you have to calculate all these steps on acquisition date only. So that's why everything, the fair value should be on acquisition date only. Okay, net asset should be on acquisition date only. Net asset should be on acquisition. Which value? Fair value. We will take only fair values and also on which date, sir? Acquisition date, not on engagement date, not on any other date. We have to take on acquisition date, nothing but control date. Are you getting my point? So based on this analysis, the step number 1 is identify the acquirer, Samantha. Next, acquisition date. Okay, 1st May. Purchase consideration. Yes, we are giving some dowry, Samantha. Next, identifiable net assets and liabilities. Identifiable net assets and liabilities of Naga Chaitanya. Nothing but ever the acquiree, not acquirer. In the question, they may give about acquirer and acquiree both details, but you should take acquiree net assets only because depends on acquiree net assets you have to pay consideration. Correct? Yes. So next, step number 5. That is nothing but come to point. Naga Chaitanya have a number of assets. Okay, simple. In this question, who have a control, sir? Samantha will get control over Naga Chaitanya. Correct? Yes, acquirer will get a control over acquiree. Suppose example, Samantha have a 100 crores. Sorry, Samantha giving 100 crores of a purchase consideration to nothing but dowry to Naga Chaitanya. In this 100 crores, 50 crores in the name of 80 crores in the name of Samantha, 10 crores in the name of his family, 10 crores in the name of his brother's family. So for example, so this 20 crores is not in the name of Samantha, right? Correct or not? So in all the assets, whatever the assets Samantha have, because Samantha may give cash or a building or whatever may be. Okay, now so she has to give purchase consideration. Correct? In this one new point will arise, that is nothing but as per business combination, non-controlling interest (NCA) or minority interest. Sir, I am not understand this point. Please explain me clearly. So, for example, A Limited holder 90% shareholding. A Limited hold 90% shareholding in B Limited. So the balance 10% shareholders is known as, that is known as non-controlling interest, non-controlling shareholders, because we have a control. A Limited have a control 90% because more than 50% is right. 51% or more, so that's why A Limited have a control over B Limited. Correct? Yes. So, but the balance 10% shareholders is known as non-controlling shareholders. Those don't have a controlling interest. So that's a non-controlling interest. Are you getting my point? Here, A Limited have a controlling interest, but balance 10% shareholders does not have a controlling interest. That's why they will be called as non-controlling interest. NCI. So we have to calculate under step 5 NCI. The last step is goodwill or gain on bargain purchase. Simple. Samantha giving 100 crores, but his net assets is 120 crores. She is giving more than net assets or less than net assets? Less than net assets. It is benefit to Samantha or not? Everything should be think in the point of view of acquirer only, because everything this Ind AS 103 completely applicable to acquirer only, not acquirer. Ind AS 103 applicable to acquirer, not acquiree. Please remind this point also. So she is giving 100 crores instead of 120 crores. It is benefit to the Samantha or not? Yes, we are giving a less amount. So it is gain on bargain purchase to the Samantha. Correct or not? Because his net assets is 120, so obviously we have to give 120 generally, but we are giving a 100 crores only. It is a benefit to the Samantha, right? So that's why it is known as gain on bargain purchase. Suppose example, she is giving 150 crores instead of 120. His net assets is 120 only, but I am giving a, she is giving a 150 crores. This difference is known as goodwill. Because of his goodwill, we are giving extra amount. It is lost to the entity, correct? It is lost to Samantha. So that's why the formula will be PC minus net assets equal to, if it is positive, goodwill, PC minus net assets equal to, if it is negative, gain on bargain purchase. Nothing but capital reserve. It is nothing but capital reserve. That's it. PC minus net assets. Nothing but we are giving 100 crores. His net assets is 120. For 120 we are giving 100 only, so the 20 will be benefit to the entity. Correct? Yes. If the purchase consideration 100 but the net assets is 80, we are giving extra amount. So it is positive 20. That is nothing but loss to the entity, nothing but goodwill. Okay, now by understanding this example, we are done with all the 6 steps. Briefly, are you getting my point? See here the 6 steps. Identification of acquirer. Stand applied to acquirer only. Stand applied to acquirer only. Determination of acquisition date. Yes. Marriage date. Identifying and measuring purchase consideration. Okay. Identifying and measuring identifiable assets and liabilities. Okay. Measuring non-controlling interest. Okay. Determining goodwill and gain on bargain purchase. These are the 6 steps you should remember. If you know all these steps, the question solving will be very easy. Can you please repeat all these 6 steps? Identify the acquirer, determine the acquisition date, identifying and measuring purchase consideration. Next, identifiable net assets. Okay, na? Next, identifiable assets and liabilities means net assets only. Measuring non-controlling interest, determine goodwill or gain on bargain purchase. Okay, na? So this goodwill have a extra formula also we will discuss. So let us start with step number 1. Okay, now clear? So these are the 6 steps. So let us start with step number 1. Identify the acquirer. Simple, sir. In order to apply the purchase method, purchase method is nothing but acquisition method. The parties involved has to identify the acquirer. Correct? That is the entity that obtains the control of another entity. Simple. Suppose example A Limited have a control over B Limited. Nothing but A Limited hold 70% shareholding in B Limited. So obviously A Limited have a control over B Limited. Correct? Yes. So the acquiring enterprise is the enterprise who obtains the control and determination of control as per guidance given in Ind AS 110. So for this acquirer definition, so they are giving us some guidance. Okay, so they have given a guidance under Ind AS 110. So let us check. The acquirer is the entity that pays the consideration except in case of reverse acquisition. That is the first point. So come to theory. A Limited acquired B Limited. Okay. So the person here acquiring by A Limited. Nothing but A Limited is the acquirer. B Limited is the acquiring. Correct? Yes. Here A Limited has to pay purchase consideration. Correct? Yes. So that is the first point. The acquirer is the entity that pays the consideration. Who is paying here? A Limited. So A Limited is the acquirer. Except reverse acquisition. Sir, what is reverse acquisition? This is nothing but reverse dowry. Reverse acquisition means reverse dowry. Suppose example, uh, uh, okay, Niveda Thomas. Suppose example. Next here, another side, Sampurnesh Babu. Okay, I think Telugu audience only may know this. May know about this Sampurnesh Babu. Like movie name Hruday Kalayam, something Kobbari Matta. Okay, so those are the movies of Sampurnesh Babu actually. So if you don't know, take any other comedian. Okay, any other comedian. Okay, if any comedian wants to acquire this, wants to marry this Nivetha Thomas, generally girl has to give the dowry to the boy, correct? Generally, but in this case boy has to give the dowry, so that is known as reverse dowry. So I think in many cases we have seen, I mean in movies also. So eduru katnam antaru. So in Telugu we can say that it is a eduru katnam, nothing but a reverse dowry. Reverse we are giving, nothing but a boy has to give the dowry to the girl, that is known as reverse acquisition. In that case who is paying acquiry is paying the purchase consideration. So that's why the definition of itself saying that the acquirer is the entity who pays the consideration except reverse acquisition, because in case of reverse acquisition acquirer will not pay the purchase consideration, only acquirer will pay in that case. So that's why this is the exception. Are you getting my point? Correct? Yes. Next, the acquirer is usually the combining entity whose owners as a group retain or receive the largest portion of the voting rights in the combined entity. So, see here, the acquirer is usually the combining entity of whose owners as a group retain or receive the largest portion of the voting rate in the combined entity. Simple. A Limited plus B Limited to form a AB Limited new company. Are you getting? After combination, after combination, suppose example, A Limited manage, sorry, A Limited, whatever the shareholders in A Limited, those shareholders have a majority of the shareholding in AB Limited. Nothing but combined entity. In combined entity, which company shareholder have a majority of the shareholding? Those are the acquirer. That is the acquirer. Nothing but A Limited is acquirer here. See here, please read again. The acquirer is usually the combining entity. Who is acquiring here? It is acquiring AB Limited acquiring A Limited and B Limited, right? Yes. Whose owners as a group retain or receive the largest portion of the voting rights in the combined entity. A Limited have some owners. Okay, na? A Limited have shareholders. B Limited also have some shareholders. Now acquiring AB Limited, right? AB Limited. So the point is saying that in combined entity, whose owners have a more voting power. Suppose if A Limited shareholders have a more voting power, so then A Limited is the acquirer. We can say that. If a B Limited is a have a more shareholding power, I mean nothing but voting power, so B Limited is the acquirer. That is the point. We have to check combining. That's the second point. Next, are you getting? Next, the acquirer is usually the combining entity whose single owner or organized group of owners holds the largest minority voting interest in the combined entity. So, simple. So, for example, A Limited, A, B, C, D. Those are the shareholders. 20%, 30%, 40%, 10%. So, in all the cases, nothing but all the shareholders does not have a control here. Correct? Yes, because no one have more than 50% voting rights. Correct? Yes, at this point, it was saying that, see here, the acquirer is usually the combining entity whose owners have, sorry, whose single owner or organized group of owners holds largest minority interest in the combined entity. After combining, okay, after combination, suppose example, this is A Limited joined with some B Limited or B Limited acquiring A Limited, B Limited acquiring A Limited. So here also same shareholders A, B, C, D something. After combination also, no one have a control, nothing but no one have a more than 50% voting right. But all the shareholders have a less than 50% only, nothing but in that case we have to check who is the acquirer. Who is that, sir? Because in all the cases who have a more minority interest, large minority interest. Who, sir? Everybody B. So B have 40%. Nothing but all the cases, nothing but A, B, C, D. Yeah, so for example, A Limited, B Limited, C Limited. So for example, X Limited and X Limited, A Limited, B Limited, C Limited, A Limited. Every company have a less than 50%. Nothing but no one have a control. But every company have a minority interest only. They comes under minority interest. Nothing but because it is less than 50%. So the point is saying that who have more large voting power, who have large nothing but NCA, nothing but minority interest. So only the largest minority interest is the combining entity, whose single owner or organized group of owners hold largest minority voting interest. Who have largest minority interest, sir? B, nothing but. So is that that is the point it was saying. Next, A Limited join with B Limited to form a AB Limited. So A Limited board of directors will be there. B Limited board of directors also will be there. Suppose example, total board of directors 10. 7 from A, 3 from B. Now, who have a dominating position in this case? Obviously, A limited, correct? Yes. So the acquirer is a usual entity combined whose owners have ability to elect or appoint or to remove a majority of members of the governing body of the combined entity. So which company? Nothing but which company have a, what is that, sir? Ability or elector to appoint or to remove a majority of the members. So they have an ability to remove the majority of the members from the combined entity. Which company have that right? That company is known as acquirer. The acquirer is usually the combined entity. Obviously, acquirer, correct. Whose owners have the ability? Whose owners have the ability to elect or appoint or to remove a majority of the members of the governing body of the combined entity. So that is the acquirer. Next, last one is which management is dominating position. Which management is in dominating position after combination. After combination, which management have a dominating position? That management company is known as acquirer. That's it. This is the simple definition for acquirer. Examination point of view not that much important, but still you have to learn simple 5 points. First one is the person who pays the consideration. Next, largest voting power in combined entity, largest minority interest in the combined entity. Next, ability to ability to elect nothing but or remove majority of the members from the combined entity, and which management dominates. So, for example, A limited company dominates after the combination, then A limited is acquired. That's the point. Clear? That is accurate. Next, acquisition date. Simple, sir. Acquisition date means the date on which the acquirer gets the control. So, for example, we already discussed about the engagement date and marriage date. So, on which date we will get control? Nothing but marriage date. Control. When the control comes. Okay, see here. Okay. Acquisition date is the date on which the acquirer obtains control over the investee. Which, sir, on the date on which the acquirer obtains control over the investee on that date. So that date is known as acquisition date. So generally it is the date the acquirer legally transfer the consideration. Acquirer has to transfer the consideration and acquires the assets and assumes the liabilities of the acquiring. Closing date. Nothing but balance sheet date. Are you getting my point? Clear? So we will get all the net assets and liabilities, nothing but assets and liabilities of acquiring, and we have to pay consideration. Nothing but we have to think in the point of view. Which point of view? Whose point of view, sir? Acquirer point of view only, because stand applies to acquirer only. Now, okay, now next, the acquirer might obtain control on the date that is either earlier or later than the closing date. Sometimes uh, obtain nothing but acquirer obtains the control if it is maybe later the closing date or earlier than closing date also. We're getting, yes. Examples: data obtaining approval, power to control operations, power to control operations. Generally, these key points will be given in question. So obviously, the question will not come from this point, but we are learning simply. Okay. In question, the different dates will be given. So if the date is date on obtaining control, so that is the acquisition date. Or in any question, power to control operations. So both points will not given in one question. Okay, na. So different questions both are. Okay, na. Sometimes we will get a approval from Competition Act, as per Competition Act. Okay, now we should get approval from as per Competition Act at that time when the approval is given. Okay, now so please check that also, check the date also when the date of approval. Okay, now so approval date, please remind that point also. For example, this is the step 2, and the next step is nothing but step 2 learn step acquisition. Sir, what is step acquisition? I'm not understanding. Simple. Please listen carefully, very very important. A Limited acquired B Limited. Okay, A Limited holds 30% in B Limited on 1/4/2020, 30th June 2020. A Limited acquired another 40% shareholding in B Limited. Now the total shareholding will get how much? 70%. Here the date of control will be 1/4/2020 or 30th June 2020. When, sir? Obviously 30th June 2020, because on the date of 1/4/2020 our controlling interest is 30%. After that it becomes to 70%. Nothing but we have a control. So this date is known as acquisition date. The way of this example will comes under step acquisition. So we are acquiring stepwise. Initially 30, later 40, or initially 20, later 30, or later another 20. So this will comes under step acquisition. Okay, now. So then what should we do? We will discuss it later. Just wait. In the case an entity acquires entity step by step through a series of purchase, then the acquisition date will be the date on which the acquirer obtains the control. So when sir acquirer obtains the control, on that date only. Till the acquisition date, the prior investment shall be accounted as per Ind AS 109 or Ind AS 28. Clear? Till the acquisition date, the prior investment shall be accounted as per Ind AS 109 or Ind AS 28 as applicable. Sir, we are not understanding this point. Can you please explain me clearly? Yes, sir. Yes. So, for example, A Limited hold 30%. Nothing but A Limited acquired 30% investment. Nothing but 30% shareholding for 10 lakhs. Okay, na? So after is 1/4/20, 30th June 20, balance 40% for 15 lakhs. Okay. So the point is saying that you have to calculate all the steps on the date of control only, nothing but on the date of acquisition date. So acquisition date means the acquirer gets the control. On which date the acquirer gets the control is known as acquisition date. Correct? Yes, he got in a nothing but right. Nothing but acquisition date is the how much date episode 30th June 2020 is the acquisition date. On that date only he got a control over B Limited, not on 1/4/2020. So the point is saying that prior investment means previous investment. Okay, so the prior investment shall be accounted as per Ind AS 109 or Ind AS 28 as applicable. So we don't know about Ind AS 110 and 128. 110 is consolidated financial statements. 28 is the investment in joint ventures and associates. So we have we have a different topic. Okay, now so just for the sake of information, just remember the standard names. Okay, the prior investment will be valued at as per Ind AS 110 or 28 as applicable. Next, in case of a step acquisition, investment held by acquirer till acquisition is remeasured at fair value on the date of acquisition, and any difference between carrying amount and the fair value of investment on the acquisition date shall be transferred to P&L and OC. So the point is saying that, sir, I already said about one point. Okay, what is that, sir? Fair value. Fair value. On which date? Acquisition date. Okay, see here, whatever the previous investment the entity have, it should be remeasured on acquisition date. Acquisition date means 30th June 2020. So the entity has to remeasure this 30% shareholding. So at which value, sir? Fair value only. At that time, so there may be some difference between these two values. Such difference will be charged to P&L or OCI. Because we are remeasuring, right? So obviously other price increases or decreases. So if it is increases or decreases, whatever maybe we will transfer to P&L or OCI. Generally P&L only. Are you getting my point? That's it. So prior investment will be treated as per Ind AS 110 and 128, and and the fair value, or sorry, and the previous investment value should be remeasured at a fair value on the date of acquisition. Then the difference will be charged to P&L or OC. That's it. Okay, now clear? Yes, simple. This is the step acquisition. Okay, now clear? Okay, now step number 3, identifying and measuring purchase consideration. So very important, simple. So first, acquisition date fair value of consideration, nothing but cash. Suppose example, we already discussed in example, Samantha has to pay some purchase consideration like dowry to Naga Chaitanya. So such dowry may be in the form of cash or gold or buildings, land, whatever may be. So the first point is cash. Okay. On which date, sir? Acquisition date. Which value, sir? Fair value. So that is the point you should remember. Acquisition date, fair value of consideration transferred from acquirer to acquiry. Okay, now next, acquisition at fair value for deferred consideration. Sir, what do you mean by deferred consideration? Simple, sir. Suppose example, the total consideration is 10 lakhs, for example. Okay. Immediately you are paying 5 lakhs rupees only. Immediately you are paying 5 lakhs rupees. Okay. So balance 5 lakhs you will pay in next year. So for example, you will pay in next year. So everyone knows about this point. So present value is different from future value. So we will pay 5 lakhs at the end of first year. But we want the calculation of purchase consideration or acquisition date only. So on this date, nothing but you have to calculate the present value for this 5 lakhs. You should bring this 5 lakhs into present value at some discounting rate. Then only you will get a correct purchase consideration, because we cannot say 10 lakhs is the purchase consideration because you are paying 5 lakhs immediately, but the balance 5 lakhs you are paying after 1 year. Correct? So for that, in this case, you should bring this 5 lakhs to the present value for 1 year. Suppose example at the rate of 10 percentage. So please take the calci. So everyone knows about this point. A equal to P by 1 plus I whole power n. Correct? This is the accumulated value. So what's the principal value? How much? Accumulated value means 5 lakhs. Okay. We want how much? Present value. Okay, correct? Yes. So please take the calci. 1 divided by 1 plus 0.1, 10%. Suppose example, whole power 1. How much? 0.909. Correct? Yes. Into 5 lakhs. How much? That is the present value. So yeah, I think everyone knows about the calculation of present value. Simply you can calculate, take the calci. So 5 lakhs divided by 1.1. You will get some value. That is the present value. So everyone should know about this present value calculation. I'm not discussing here. Are you getting my point? Correct? What is the formula? 1 divided by 1 plus I whole power n. So, for example, for 1 year the value is 0.909. Nothing but at the rate of 10%. 1 plus 10% means for 0.1 whole power 1 how much? 0.909, which means the present if the present value is 0.909, if you deposit 0.909 rupees in a bank on this day today, after 1 year at the rate of 10% rate of interest you will get a 1 rupee. That is the meaning of this present value. At the end of the 1 year, the value is 1 rupee, but now the value is 0.909 only. Now the value is 0.909 only. That is the present value calculation. Everyone knows about this time value of money. Okay, now so that is the deferred consideration. So when the consideration is deferred, you should calculate the present value of future payments, not to today. Suppose example, total consideration 10 lakhs. Immediately you are paying 1 lakh. So 1 lakh. At the end of the first year, you are paying 5 lakhs. At the end of the second year, you are paying balance 4 lakhs. Now, what is the calculation? You should bring this 5 lakhs to present value at the rate of 10% for 1 year. 1 year. Next, you should bring this 4 lakhs also to the present value. Bring to the present value at the rate of 10% for 2 years. So the calculation will be 1 divided by 1.1 whole square. For first year, 1 divided by 1.1 whole power 1. For second year, 1 divided by 1.1 whole square. For third year, 1 divided by 1.1 whole power 3. Okay, now, so this is the calculation for present value. Are you getting? So then we will get a complete present value. Nothing but that is a deferred consideration. Okay, now, clear? This is known as deferred consideration. Next, sir, if in the given question, then if they give the deferred consideration value also, then you can take directly. If they will not given, you have to calculate. Which value? Fair value. Which date? Acquisition date. That's it. Simple. Next, fair value of contingent consideration. What is it, sir? Contingent consideration. Contingent means happening or non happening of a uncertain future event. Correct? Yes, contingent means we cannot say exactly. Okay, so the consideration will pay or not depend upon the profits, depend upon the profit, whatever may be the conditions, based on depends on conditions. If the condition is okay, then he will pay consideration, otherwise he will not pay. But still, as per Ind AS 32 and 109 financial instruments, fair value of contingent consideration also should be considered. Okay, now so contingent means you have to pay nothing but treated as a liability. It's a financial liability. Okay, now so for calculation of purchase consideration, you should take the contingent consideration also for calculation of purchase consideration. Okay, now please remind this point. So generally contingent means we will not take, but as per Ind AS 32 and 109, we will take this contingent consideration also. Okay, now which value? Fair value. Which date? Acquisition date. Next, acquisition date fair value of share based payments to the extent the period expired. To the extent period expired. Acquisition date fair value of share based payments to the extent period expired. What's the calculation? Acquisition date fair value of original awards into completed vesting period by original vesting period or revised vesting period, whichever is higher. So, see one example. Simple. So, for example, A Limited, A Limited granted to employees 1,000 options. How much? 1,000 options. Okay, now. So, the vesting period is suppose example 3 years. If the employees remains in an organization, so they will give services for a period of 3 years, then only entity will give these options. Otherwise, entity will not give. This is the condition. So this condition is known as vesting conditions, right? This condition is known as vesting conditions. For satisfying those vesting conditions, entity will give some time period. The time period is known as vesting period. We already discussed this in Ind AS 102, right? Okay. Suppose example, initially the vesting period is 3 years only. 3 years. How many options? 1,000 options or 1,000 shares, whatever may be. See here. Acquisition date fair value of share based payment to the period expired. Suppose example, after 2 years, A Limited merged with okay. After 2 years, A Limited joined with the B Limited. Nothing but B Limited acquired A Limited. After 2 years, B Limited acquired A Limited. So now everything comes under the control of B Limited only. Yes, correct. So who will give the options? Now who will give the options to the employees? So employees remains in that particular organization only. But now B Limited got a control over the entity. So he has to give options to the employees. So come to this point. Acquisition date, fair value of original awards. Suppose example, if it is 1,000 shares, assume that 1,000 shares. Fair value of share is suppose example 100 rupees. Suppose example 100. 1,000 options or shares, whatever maybe. Okay, so 1,000 into 100 rupees fair value. How much? 1 lakh. This is the acquisition date fair value of original awards. So A Limited A Limited granted to employees how many, sir? 1,000 only, right? So 1,000 at the rate of 100 rupees. Assume that the fair value is 100. On which date? On which date? Acquisition date. Which value? Fair value. So this is the original awards value. Fair value of original awards. These original awards should be apportioned based on, see here, the formula. Completed vesting period, because the completed vesting period here is only 2 years. 2 years divided by original vesting period. How much? 3 years. That is the original vesting period. 2 years already completed. Okay, we have to book that particular expense like. So for that, whatever the period expired, okay, to the extent of that we have to pay consideration. Okay, now, correct? Yes. Suppose example, original vesting period is 3 years. Suppose example, B Limited changed or revised from 3 years to 4 years. 3 years to 4 years, or 4 years, whichever is higher. So go to formula. Acquisition date fair value of original awards 1 lakh. Computed vesting period 2 years divided by original vesting period or revised vesting period, whichever is higher. So original vesting period is 3 years. Revised is 4 years. Whichever is higher means you should take 4 years. Correct? So this is the calculation for 2 lakhs by 4. How much? 50,000. That is the consideration. Acquisition date fair value of share based payments to the extent the period expired. To the extent period expired. In this example, 2 years is the completed vesting period. 3 years is the original vesting period. Revised vesting period is 4 years. So we have to apportion based on revised vesting period. If the vesting period is not revised based on original vesting period only, you should apportion that particular original awards. Which value? Fair value. Which date? Acquisition date. Please don't forget this point. Acquisition date is the very important, and fair value also very important. You should take all the, for all the points, for all the steps also you should consider fair values only. Okay, now clear? This then issue next acquisition and fair value of securities issued. If you are issued any securities, shares, equity shares, or preference shares, or debentures, okay, so that's also should be considered. You will get a purchase consideration. That's it. This is the step number 3. Clear? Can you please repeat? Acquisition at fair value of cash. Acquisition at fair value of deferred consideration. Acquisition at fair value of contingent consideration. Acquisition at fair value of share-based payment to the period expired. Acquisition at fair value of securities issued. Then we will get purchase consideration. That is step number 3. Note point. Direct cost of acquisition. For acquiring, you may incur some expenses, charges. So that is not included in the determination of purchase consideration, and those costs will be charged to P&L only. Are you getting my point? For calculating purchase consideration, if you are incurred any cost of acquisition, direct cost of acquisition, and it should not be included in the calculation of purchase consideration. So that is the point. Okay, now so direct cost of acquisition is not included in the calculation of purchase consideration, and it will be charged to P&L. Okay, now please note this point also. And the acquirer shall classify an obligation to pay contingent consideration as a liability or equity as per Ind AS 32. So as per Ind AS 32, the acquirer shall classify an obligation to pay contingent consideration as a liability or equity. So depending upon the conditions, it will be treated as a liability or an equity. So as per Ind AS 32. Okay, now so we have to recognize it. So that's why we are considering in purchase consideration calculation also. That's it. This is the step number 3. And step number 4 is simple step. Identifying and measuring identifiable assets and liabilities. Nothing but which entity? Acquiring entity. We already discussed an example based on the net assets of the Naga Chaitanya. Correct? So based on the net assets of Naga Chaitanya, Samantha has to pay purchase consideration. So now you have to calculate acquiring net assets. Nothing but assets and liabilities. Assets minus outside liabilities. That is nothing but net assets. Okay, now so step number 4. You have to calculate the net assets of acquiring entity. Acquiring entity. On which date? Acquisition date. Which value? Fair values. You should take only fair values of acquiring entity net assets. Assets or liabilities, you should take fair values only. In the given question, if the fair values is not given, you should take book values. Then you can take book values. Until and otherwise, if the fair values are not given, then only you should take book values. Otherwise, if the fair values is given for every asset or every liability, you should take fair values only. On which date? Acquisition date. So in the given question, they may confuse you. So they will give all the, suppose example, acquisition date fair values as well as some other date fair values are given. So you should take acquisition date fair values only. That is the main point. So acquisition date net assets. Which value? Fair value. Nothing but fair value of net assets. Net assets means total assets minus outside liabilities. That's it. All assets and liabilities are measured at fair value at acquisition date. Acquirer can recognize only those assets and liabilities which meet the definition of asset and liability. That's a recognition. Which entity, sir? Please remind that acquiring entity, not acquirer. Acquiring, because based on acquiring entity net assets only, you should pay the purchase concession. Correct? And the last step is measuring non-controlling interest. NCA. Non-controlling interest. Simple, sir. Simple. Very, very simple. Non-controlling interest. For calculation of non-controlling interest, we have two methods. One is fair value method. Second one is proportionate net assets method. Okay. So first method is fair value method. Under fair value method, the calculation for NCI is simple, sir. Number of shares held by NCI into fair value of share on acquisition date. This is the formula for NCA under fair value method. What is the formula, sir? Number of shares held by NCI into fair value of share on acquisition date. Suppose example, A Limited hold 80% shareholding in B Limited. So the balance 20% is known as NCA, correct? Yes. So the total number of shares in B Limited is 1 lakh. Out of 1 lakh, 80% acquired by A Limited. So the balance 20,000 shares held by NCI. So therefore, number of shares into fair value of a share on the date of acquisition. So the example of 15 rupees. Total 3 lakhs. This is the calculation for NCI under fair value method. This is one type of example. And one more example. A Limited holder, A Limited acquired 80% in B Limited for 10 lakhs. For 10 lakhs. Or 8 lakhs. Sorry. For example, 8 lakhs. Okay now. So in the given question, number of shares is not given. Number of shares is not given. Now you have to calculate the NCI under fair value method. How to calculate? See here, simple sir. For 80% of a shareholding, A Limited paying 8 lakhs amount of money. So the for 20% shareholding, what is the value? Simple. How much? How much, sir? So for 80%, A Limited paid 8 lakhs. So the balance 20%, the value will be how much, sir? 8 lakhs by 80 into 20. How much? 2 lakhs. So therefore, under fair value method, NCA value will be 2 lakhs. Okay, if the number of shares is not given, you can still you can calculate the value of NCA. This is the example 2 for fair value method. This is the example number 1. Next method, proportionate net assets method. Under proportionate net assets method, calculation of NCA. What are the formulas are simply acquisition date fair value of net assets into NCI percentage. Suppose example, A Limited holder or A Limited acquired 80% in B Limited. A Limited hold 80% in B Limited. So the balance 20% is NCA. So acquisition date fair value of net assets of acquirer or acquiree. Acquirer is called acquiree now. Acquiree, sir. Acquiree. Correct? Yes. So for example, net assets of acquiree, nothing but B Limited, is 10 lakhs into 20%. How much? 2 lakhs. So 2 lakhs is the value of NCA under proportionate net assets method. If in the given question, nothing saying about the method, nothing but whether it is a fair value method or a proportionate net assets method, you should calculate based on proportionate net assets method only. Okay, net asset method only. If the question is silent about the method of NCA, you should calculate the value of NCA on the basis of proportionate net assets method. The formula will be acquisition date fair value of net assets into percentage of NCA. If the fair values is not given, you can take book values also. But for confusing, in the given question, they will give two values, nothing but fair value of net assets on acquisition date and fair value of net assets on year ending date. Year ending date. So which value you should take, sir? Acquisition date, net assets fair value only. Okay, now this is the calculation of NCA. Okay, now. Okay, now simply this is the calculation for NCI, non-controlling interest. We have two types of methods. One is fair value method. Second one is proportionate net assets method. Under fair value method, the formula will be what is it, sir? Number of shares held by NCA into fair value of a share on the acquisition date. Under proportionate net assets method, the formula will be net assets into percentage of NCI. Which date, sir? Acquisition date. Which value? Fair value. Okay, now. Simply, this is the calculation for NCA. Okay, just wait. Okay, now. Okay, this is the step number 5. And the last step is determination of goodwill or gain on bargain purchase. Determination of goodwill or gain on bargain purchase. Very simple. First, the formula will be PC plus NCA minus net assets. What is the formula, sir? PC, purchase consideration plus NCA, non-controlling interest minus net assets. Minus net assets. So, if the value is positive, it is goodwill. If it is negative, then gain on bargain purchase. Sorry, sir, I'm not understanding. So, please tell me with an example. Sorry. Okay, now see here. See the example. చూడండి. Suppose example, A Limited acquired 80% shareholding in B Limited. Okay, na? For 8 lakhs. How much? 8 lakhs. The value of fair value of net assets on acquisition date of B Limited is, suppose example, 12 lakhs. 12 lakhs is the net assets value. On which date? Acquisition date. Which value? Fair value. Okay. Now, the question is silent about the method of NCA. Okay. You should calculate based on proportionate net assets method. So then the NCA value will be how much? Net assets into percentage of NCA. How much? Net assets how much? 12 lakhs into what's the NCA percentage? 80% we are acquiring. So balance 20% will be the NCA percentage. How much? 2 lakh 40,000. That is the value of NCA. Correct? Yes, sir. So we already discussed in Samantha Nag Chaitanya example. Okay. Simple. Okay, we already discussed about this example. In Samantha Nag Chaitanya example, Samantha has to pay purchase consideration to Nag Chaitanya based on net assets of the Nag Chaitanya. Suppose example, if he is a poor man, if he is a village person, he is not an actor. So Samantha will pay 100 crores or not? No, just because of her depend on the net assets value only. Correct? Yes. Suppose example, the value of in our example, the value of Nag Chaitanya is net assets value how much? 120 crores. Samantha is paying 100 crores, right? Samantha is paying 100 crores. Here the purchase consideration is 100 crores only. But net assets of Nag Chaitanya is 120. Okay. Samantha is paying higher than net assets or lower than net assets? Lower than net assets only. So the difference will be the gain to Samantha as per that example. In our business combination, Samantha has to pay purchase consideration based on the net assets of the acquiring entity. If you are paying more than the net assets, the difference is known as goodwill. If you are paying less than the net assets, the difference will be the gain on bargain purchase. What is that, sir? Gain on bargain purchase. Because the value of net assets is 120, we are paying 100 only. So the balance 20 is benefit to us. To us means acquirer, not acquiring. In acquirer point of view, that balance 20 is benefit to the acquirer because we are paying 100 crores instead of 120 crores. For 120 crores of a net assets value, we are paying just 100 crores only. The balance, the difference 20 crores is a benefit to the acquirer. Correct? Yes, sir. Prasad? Okay. Go outside. Okay. Just wait. Okay, so we are paying 100 crores instead of 120 crores. Okay, so we already discussed about this example. Net assets value is 120. Purchase consideration is 100 only. So the difference 20. If the difference is a positive, it is goodwill. If the difference is negative, it is gain on bargain purchase. Correct? Yes, we already discussed about this example. But in this case, we are acquiring 100% of Naga Chaitanya. Correct? So in our business, so for example, A Limited acquired B Limited of 80% only. 80%. So the for 80% value is 8 lakhs. Okay. The net assets of B Limited is 12 lakhs. 12 lakhs. Now the NCA calculation, how much, sir? NCA calculation 12 lakhs into 20%, how much? 2 lakh 40,000. 2 lakh 40,000. This 12 lakhs is the net assets, sir. 100% net assets, sir. Please don't forget about this point. The net assets means it is 100% total net assets of B Limited. So that's why in our formula NCA is adding. So the formula is PC plus NCA minus net assets. So PC means we are paying purchase consideration for 80% only, and net assets is 100%. So that's why we have to calculate NCA also. Okay now. So 20% of NCA. So generally when we are comparing, you have to compare the equal values, right? Correct? So that's why in our formula, NCA also comes. PC plus NCA minus net assets. It is 80%, it is 20%, total 100%. If the balance is positive, it is goodwill. If the balance is negative, it is gain on bargain purchase. Simple point. In goodwill point, nothing but for goodwill calculation. Okay, sorry. This goodwill calculation is very, very important for examination purpose. This all the 6 steps is very, very important. Okay, but goodwill calculation is very, very important. For calculation of goodwill, what are the requirements, sir? One is PC, nothing but steps. Step 3. Next, NCA, step number 5. Next, net assets, step number 4. So simply, if you want to calculate step number 6, you have to calculate step number 3, 4, 5 also. So that's why the calculation of goodwill or gain on bargain purchase is very, very important. So the formula will be PC plus NCI minus net assets. You will, if the balance is a difference is positive, you will, that is known as goodwill. If the difference is negative, that is known as gain on bargain purchase. Simple, sir. Use your common sense, sir. You are paying 100 crores. The net assets value is 120 crores. So for 120 crores, you are paying 100 only, na. So the balance 20 is gain on bargain purchase to the acquirer entity. So this all everything calculation in your books. Sorry, in whose books, sir? Acquirer books only. Correct? Yes. So suppose example, if the net assets is 120, you are paying 140 crores PC. So the difference 20 is you are paying extra 20, that is lost to the acquirer. So that is known as goodwill. You are paying just because of goodwill only. That is the very, very important point. So one more point is adding here in our formula PC plus NCA plus fair value of acquisition date, fair value of previously held investment minus net assets. So the example simple. PC, you are acquiring a, suppose example A Limited acquired 30% in B Limited on 1/4/2020. On 1/6/2020, acquiring another 40 percentage in B Limited. Okay, when you are acquiring 30%, you will pay some amount. Suppose example 3 lakhs. Now you are acquiring 40%, you are paying 5 lakhs. So total how much? 70%. So you got a control. So on the date of control only you should calculate. You will calculate all these steps. Okay, then only we can say it is a business combination, right? So PC how much on this date, on the control date, on the acquisition date, the PC how much for 40%? How much? 5 lakhs. Previously held investment how much? 3 lakhs. 3 lakhs for 30 percentage. Okay. So the balance how much? 30% is NCA. So you have to calculate the NCA also. So for example, net assets value is 15 lakhs. 15 lakhs into 30 percentage, 4.5 lakhs. Correct? Yes. So net assets how much? 15 lakhs. So 9.5, 12.5 minus 15. How much? 2.5 is the negative. This is known as gain on bargain purchase. When we are comparing, we have to compare equal values, right? We are reducing 100% of our net assets. Then you should take the 100% of a value. So that's why PC 40, NCA 30, and previously held previously held investment also you should take. Which value? Fair value. On which date? Acquisition date. So see here, this 3 lakhs is the value as on 1 4 2020, not on 1 6 2020. We already discussed about this step acquisition point. Correct? Yes. So for example, on this date, the 3 lakhs value become 4 lakhs. Okay. So for example, the 3 lakhs value increases to 4 lakhs because we are taking fair value on acquisition date, right? So this 30% value on acquisition date is 4 lakhs. So total how much? 9.5, 13.5, 1.5 negative. So 1.5 is the gain on bargain purchase. So we already discussed about this step acquisition point. If there is any difference between the fair value and the carrying value of a previously held investment should be transferred to P&L or OCI. Correct? Yes, we already discussed about this point. Examination point also very, very, very important. Please don't forget about this. Okay, now. So the formula, ultimate formula will be PC plus previously held investment. Which value? Fair value. Which date? Acquisition date. Minus net assets. If the value is positive, that is goodwill. If the value is negative, that is gain on bargain purchase. It is nothing but capital reserve. Correct? Yes, sir. That's it.
Okay, now. So on Ind AS 103, we are done with the steps already, right? So this question is very, very important. So the difference between the AS14 and 103. Okay, now everyone. So go through that question also. Examination is only so narrow scope, method of accounting, both pooling and so pooling interest and purchase method will be there in AS14, but here only acquisition method, fair value, book value. So all these basic basic points you need to identify, and you have to study that question also for examination point of view, very important. Okay, now are you getting my point? So we don't have a lot of time for this. Okay, we'll upload a few questions. Actually, we already uploaded 3 questions. That too, three lectures regarding the directly uploaded 3 lectures in marathon for getting a clarification about the basics. If you know the basics very well, definitely you will crack the question. Okay, if you know the all these 6 steps, okay, definitely you will answer the question. Clear, everyone? Okay.
Hello guys, next accounting in the books of acquiry, right? Simple, sir. Acquiry. Actually, India's 103 does not deals with acquiry books. India's 103 applicable to only acquirer. Then what is the acquiry accounting, sir? Acquiry accounting means simply acquiry books was closing, right? You should close acquiry books. Correct or not? Yes, sir. Simple. So, for example, it is a balance sheet, fixed assets, current assets. Next, equity share capital, other equity. Next, non-current liabilities, current liabilities. So, generally, this is the balance sheet. This is the balance sheet. Simple. Accounting in the books of acquiry on acquisition. On acquisition. Simple, sir. So, for example, A limited is the acquirer. B limited is the okay. So, B limited is the acquirer. Now we want to close the acquiry books. Closing means simply uh, closing all the assets and liabilities. Simply closing the balance sheet. Closing the balance sheet is nothing but closing the books of acquiry. So balance sheet closing means simply generally asset have a debit balance, right? Okay, so it should be eliminated right now. You have to eliminate the asset, nothing but you have to credit the asset. For liability, generally it will be credited. If you want to close the liability, then it should be debited. Correct or no? Yes. So simply liabilities account debit to asset account. Correct or not? Say yes or no. So generally you should close all the liabilities and close all the assets. Clear. So here, first of all, you should close all the assets. What is that, sir? You should close all the assets. By when you are closing the assets, it should be transferred to. It should be transferred to when a special account is known as realization account. What is that, sir? Realization account. You should transfer that particular assets to realization. Simple. Then entry will be assets will be reduced, right? So to assets account. Then what should be debited? Realization account will be debited. This is the entry for closing the assets. Are you getting my point? For liabilities, entry will be liabilities to realization. Correct or not? Yes. So go to theory. First of all, for transferring of assets by transfer to realization account. So entry realization account debit to assets account, all assets. At which value, sir? You should take only book value because in balance sheet there is only book values available. So that's why you should close it at book values only. So entry will be realization to all assets. Which value? Book value. And also you should transfer external liabilities also. You should transfer external liabilities. Not equity, share capital and other equity. Okay, external liabilities, nothing but like long-term liabilities, debentures, current liabilities. So these will come under external liabilities. So it will transfer to realization account. Entry will be external liabilities to realization account. At which value? Book value. Simple, sir. I'm closing my assets by transferring to realization account. I'm closing my liabilities by transferring to relation account. Relational account. Then third entry will be the due entry for consideration. You are the acquirer. You will get some purchase consideration from acquirer. Okay, you have to write the due entry. Due entry means uh, you have not yet received that particular consideration amount. Present till now you did not receive, but you will receive in future. Okay, now so the entry will be okay. You should receive money from acquirer company. So acquirer company account debit to realization account. Entry will be what's entry, sir? Acquirer company. Simple, sir. You have to receive the money from acquirer. So that's why you are debiting acquirer company account. So for the example, P limited. Okay, now are you getting my point? Because money has to be received from acquirer company. So when you are receiving, all receivables will be debited like a debtor, sir. Acquirer, like a debtor. You have to receive money from acquirer company. So that's why entry will be acquirer company to realization account. Sir, why realization account? Because generally based on net assets only we are giving a purchase consideration, or we are taking a purchase consideration. So our all assets and liabilities transferred to relation already. So that's why you will take a realization account only. That's it. Next, internal liabilities. Internal liabilities means equity share capital. Equity share capital and other reserves. Just wait. In our balance sheet, equity share capital and other equity also will be there. These are known as general internal liabilities because it will be it is related to owners, nothing but equity shareholders. So first of all, you should transfer equity share capital and other equity to equity shareholders account. Okay, now are you getting my point? Equity share capital account, other equity account debit will be transferred to equity shareholders account. Okay, you have transferred. Other equity means it's nothing but a profits, reserves. If there is any accumulated losses, then it also will be transferred to equity shareholders because profits or losses will be shared by equity shareholders only. So that's why entry will be equity shareholders to P&L account. If there is any loss, it also should be bared by the equity shareholders only. If it is a profit, shareholders of balance will be increased. So that's why it is credited. If it is a loss, his account will be debited. Correct or not? Because loss also will be bared by the equity shareholders only. So that's why equity shareholders to P&L. Are you getting my point? Next, after that, you will receive the purchase consideration amount. It may be in the form of equity shares, or a preference shares, or a debentures in the transferee company, or a cash. Okay, whatever the case may be. Simple. See here. Generally, in our case, in our example, A limited is the acquirer, B limited is the acquirer. Acquirer means transfer or transferee. Simple, sir. We are acquiring B limited. So B limited is transferring the all assets and liabilities, right? So obviously B limited is known as transferor. Then A limited is known as transferee. So the wording is important. Please don't confuse. Acquirer is not same as transferor. Acquirer means transferee. Acquiree means transfer. Because acquiree only transfer all the assets and liabilities. So that's why transferor is known as acquiree. Transferee is known as acquirer. Please don't get confused in this point. Okay, now. So I'm receiving the purchase consideration. Equity shares in transferee company, nothing but A limited, equity shares in A limited, preference shares, if there is any preference shares given by the A limited, then preference shares in A limited, debentures in A limited, or cash or other assets to acquirer company. Purchase consideration account will be closed because we are debited that acquirer account in third entry. Correct? Due entry. Nothing but we have to receive money or shares or whatever maybe from acquired company. No, you already received. Then acquired account will be closed. It will get closed. Okay, now is there any preference share capital in acquired books? It also should be transferred to preference share holders account. Then settle to that. Then you have to settle to preference shareholders. First of all, you should settle to preference shareholders. Okay, now. So preference shareholders to bank. Is there any shares given? Two shares or two debentures in acquiring company. Okay, now. For relation assets not taken over. Okay, if the some assets are not taken over by the acquirer, then you have to realize. The entry will be generally if the asset is selling. Realize means selling. Suppose an example I am selling one asset, so then I will get money. So bank to generally asset account will be credited, but here there is no asset account right now because we already transferred to realization account. So then entry will be bank to realization. In liability case, relation to bank. Okay, now then you will get a under relation account. There may be profit or loss, whatever may be. It should also be shared to equity shareholders. If it is a profit, equity shareholders balance will be increased. If it is a loss, equity shareholders balance will be reduced. Then ultimately settlement to equity shareholders. That's it. Please come to please listen this point again. Very simple. First, realization account to assets account, correct? At which value? Book value. Next, close the liabilities. Liabilities, external liabilities, nothing but outside liabilities. So then, outside liabilities or external liabilities to realization account. Correcta? Yes. Next, due entry for purchase consideration. So entry will be acquirer company account debit or shares in acquiry. If the shares given by the acquirer, so you can write that one also. Simply acquirer company to realization account, PC amount, purchase consideration amount. Here also book value of assets, so liabilities. Next, one more point you should add here. What does that means? Realization expenses. Realization expenses, sir. So then entry will be relation to bank account. For realizing some expenses will be incurred by acquiry. So then entry will be relation to bank account. Next, if the assets are not taken out by acquirer, then you have to release that assets. You have to release that assets. So then entry will be bank account debit to realization. Bank account debit to realization. For settling the liabilities, realization to bank. Settling means you are paying. So that's why relation account debit to bank account. Are you getting my points? Clear? Okay, na? Okay. Next. So ultimately, you will get relation profit or loss. Simple, sir. Relation account means nothing but see here, two assets. Dispose this by outside liabilities by acquirer company. Next, to bank by bank. Okay, now to bank by bank. Next again to bank. Bracket low you have to write specifically. Then if the credit side balance is more than debit side, then you will get a realization profit. It should be transferred to equity shareholders. If the debit side is more than credit side, then you will get a realization loss. Same like P&L account, sir, because realization account is nothing but nominal account. Same like P&L. So then relation loss also will be transferred to equity shareholders. For relation profit, entry will be in case of a profit, equity shareholder balance will be increased. So that's why realization account debit to equity shareholders. For realization loss, then equity shareholders to realization account. These are the entries, sir. And then come to preference shareholders. Come to preference share capital and other equity and equity share capital. These are the last points. Simply preference share will capital will be transferred to preference shareholders. Other equity will be transferred to equity shareholders. Equity share capital also will be transferred to equity shareholders. And also purchase consideration receipt entry. Receipt of PC. Then acquirer account will be credited because when the due entry for purchase consideration entry will be acquirer company to realization. Now you are receiving the purchase consideration, so to acquirer company. So debit side, whether it may be cash or shares in equity, shares in acquirer company, or equity shares, whether it is a preferential or equity shares or debentures in acquirer company. So whatever may be. So the entry will be this is the entry. And last one you have to settle to equity shareholders. This is the way you have to prepare. You have to write the journal entries in the books of acquiring. I hope you understand everything. Please once revise the entries and then come to question number 7. Okay, so come to question number 7. The first entry will be, you have to close the books of Q Limited. You should take only the book values, right? Okay. So net assets how much? Q Limited 42 lakhs. Equity share capital 25. Other equity 17 lakhs. First entry will be, here there is no assets and liability separately. Directly net assets. So entry realization to net assets. Correct? Yes. How much? 42 lakhs book value. So step number 1, step number 2 also complete because assets and liability. Step number 3, point number 3, purchase consideration due entry. So acquired company to realization account. Simply acquired company is giving equity shares, right? So you have to receive the equity shares in K limited or P limited. P limited, sir, not K limited. Equity shares in P limited to realization account 48 lakhs. This is the PC. Correct? So there is no other relation expenses. Everything is not there. So that's the difference. How much? 6 lakhs. Relation account credit side amount 48, debit side amount 42. Then credit side increased by, credit side is more than debit side by 6 lakhs. So that's the relation profit. It will be transferred to equity shareholders. So relation account to equity shareholders 6 lakhs. That's it. Now you have to transfer equity share capital as well as other equity to equity shareholders. So what is equity share capital of Q Limited? 25 lakhs and 17 lakhs. So then it will be transferred to equity shareholders. So 25 plus 17, how much? 42 lakhs. Now you have to, now you will receive the equity shares in, equity shares in P Limited. So what is the due entry for purchase consideration? Equity shares in P Limited to realization. Then equity shares in P Limited to realization. Nothing but you have to receive that equity shares. After settlement of, after transferring all the equity share capital and the other equity to equity shareholders, now you have to give acquired company's equity shares to equity shareholders of your company, nothing but acquiring company. So simple settlement to equity shareholders. So equity shareholders to equity shares in P Limited. So the second will get closed, right? See here, equity shares in P Limited debit side, equity shares in P Limited credit side. So the account will be closed. Will get closed. How much? 48 lakhs. Clear? Are you getting my point? Simple or not? So this is the relation account also. Simply you can prepare. This is known as relation profit. Simple sir. First entry, relation to net assets. Next, purchase concession due entry. So equity shares in P Limited to relation account. No other relation account entry. So that's why the difference between those two is known as profit or loss. Here relation profit, then it will be transferred to equity shareholders. So relation account debit to equity shareholders. And then equity share capital and other equity also transferred to equity shareholders. How much? 42. So the here 42 lakhs debit credit side and 6 lakhs credit side, total 48 lakhs you have to pay. So for 48 lakhs you are issuing equity shares, you are giving equity shares in P Limited. So 48 lakhs. Clear? Clear or not? Yes. This is the journal entries in the books of acquiry. Very simple, sir. Clear? This is the relation account, simply posting. If you know about the entries, you can write easily. This is the equity shareholders account. It also you should be posted along with entries. Okay, now very simple, sir. This is the very important question. Clear? Okay. Next question number 8. I have already given a homework. Okay. Next video we will discuss about question number 9. Next 10. Okay, 11 it will be discussed in next video. Thank you. Hi guys, good morning to all. Next topic, reconstruction. Simple sir, it's very simple topic. Reconstruction means simply to reconstruct the balance sheet of an entity. So generally, when reconstruction will take place, simple, when a company making losses for several years, okay, it's a financial position do not represent the true and fair. In such a case, the assets are generally overvalued. Assets are generally overvalued at that time, and also go and ask the shareholders, creditors, debenture holders. So nothing but liability. So simple company ask that the creditors or shareholders or preference shareholders or debenture holders, sir, please reduce your amount. Sir, please reduce the liability. Okay, so please do some favor for me. So like this, a company will ask all the shareholders as well as the debenture holders as well as the creditors, other liabilities, etc. Okay, now are you getting my point? Are you getting my point? Simply, company will reconstruct their balance sheet. Reconstruct their means simple. Suppose example in balance sheet, fixed assets 10 crores, current assets 5 crores. Okay, equity share capital 5 crores. Example, preference share capital 1 crore, debentures 5 crores, other liabilities, reserves 5 crores, 10, 50, sorry, reserves 2 crores, and other liabilities 2 crores. Total 1550. Assume that. Simple. On the date of reconstruction, when the company making continuously losses, then assets will be revalued. Assets will be revalued, whether it may be upward revalued or a downward revalued. Okay, now. So, and also go and ask the debenture holders, preference shareholders, other liabilities means creditors or other equity shareholders. So go and ask them, sir, please reduce your amount. I am unable to pay this much 5 crores amount. So can you please reduce at least 30 to 40%? So, for example, debenture holders agrees to waive off that 40%, nothing but suppose example 50%. So, balance 2.5 crores will be the liability to the entity company. No need to pay 5 crores here, just 2.5 crores is more than enough. Okay, after this reconstruction, uh, some benefit will come to the entity. With that benefit, entity will write off the losses. Entity will write off the because company have losses, so that's why we are doing like this. Correct? Yes. So after getting the benefit, after reducing all the amounts, everything, with that amount they will write off that loss to bear that loss. Okay, now and also see here. Balance sheet consists of fictitious assets, unpresented intangible assets, debit balance of in P&L. What is it, sir? These also these also existed in balance sheet sometimes. Okay, you have to write off that. You have to, for example, generally in reconstruction, if there is any benefit, you get the benefit that will transfer to capital reduction account. What is that? You should transfer that balance amount to capital reduction. Example, debenture holders, 5 crores you have to pay, but you are paying now. They waive off for 2.5 crores or 2 crores. So, for example, 2 crores waive off for nothing but 2 crores. Uh, no need to pay by the company. Just 3 crores is enough to pay. So, this 2 crores waive off by the debenture holders. That 2 crores is a benefit to the entity. So, that will be transferred to capital reduction account. That will transfer to capital reduction account. It's a benefit. So we have to credit it to capital reduction account. Are you getting my point? So I have present total 2 crores of capital reduction balance. With that balance, I will adjust or write off the P&L debit balance initially. What is that, sir? P&L debit balance. Nothing but is there any loss? Please adjust to it. So for example, it is 1 crore. Next, if you have a goodwill in the balance sheet. So write off that goodwill also. So for example, 50 lakhs. Are you getting my point? Next, if the question says to write off anything, generally fictitious assets also you should write off. Fictitious assets also you should write off. So then, is there any balance pending that will transfer to capital reserve account? Is there any balance in capital reduction account that will be transferred to capital reserve account after write off all things? Are you getting my point? Simple. Reconstruction is of two types: internal reconstruction, external reconstruction. In internal reconstruction, there is no new company will be formed. Existing company's balance sheet will be reconstructed. That's it. There is no need to form a new company. But under external reconstruction, new company is formed by existing shareholders of an old company. Old company existing shareholders continued in new company also. That's why it's a common control transaction. We already discussed a problem about this. Correct? Yes. Because before and after the control will be remain same. Like with the same persons. Next, company will liquidate or not liquidate. Sir, no need, sir. No need to liquidate here because just we are reconstructing the balance sheet. No need to liquidate it. Here, old company will be liquidated. Here, for internal reconstruction, court approval will be required. Court approval will be required, but in case of external reconstruction, court approval need not be required. No need to get any court approval. Use the specific terms in balance sheet and reduced. What's it, sir? Under internal reconstruction, you have to use the word unreduced. After, for example, this is the balance sheet after reconstruction. What should you write, sir? And reduced, which resembles, which represents the balance sheet is reconstructed. The balance sheet is reconstructed. Okay, now clear? Simple, sir. General reconstruction. When the company making losses, okay, the company will reconstruct their balance sheet, okay, by overvaluing the assets, by reducing their liabilities, by reducing their capital shares. Okay, now. So ultimately they will get some benefit. With that benefit, they will write off the P&L. Is there any P&L debit balance? Nothing but loss. It should be write off with that amount. And is there any extra balance? Reduce the goodwill. And is there any balance? Is there any? If the question specifically says anything, you should write off that also, and the balance should be transferred to capital reserve. That's it. Okay, now let's go to the examples. And also differences between internal reconstruction and external reconstruction. So please remind that point also. That question also 4 marks question maths we don't know. Okay, now next, journal entries. Subdivision of shares. Subdivision means suppose example, the share value is 100 rupees. Now we are split off into 10 rupees. Suppose example, there are 100 shares. Each one is 100 rupees. Total value 10,000. Now I am subdivision. Nothing but out of 100 shares will be divided into 10 shares. 100 shares will be divided into nothing but into 10. How many? 1,000 shares. So then the value becomes 10 rupees. Correct? Yes, sir. 100 shares is 100 rupees. Okay. 100 shares. Each one is 100. Now I am subdividing. Nothing but for one share, for sorry, for 10 shares I am giving one share. Nothing but for 100 shares I have to give 10 shares. So how many shares total? Total shares coming to into 10. 1000 into 10. For each share I am giving 10 shares. For example, for each share I am giving 10 shares. The number of shares will become 1000 shares into 10 rupees. The face value will remain changes. Correct? See here. By splitting of one equity shares of 100 rupees into 10 each of 10 rupees each. Each equity share ki 10 shares ఇస్తున్నాం. We are giving 10 shares for each share. Then the share value becomes 10 rupees. Now, what is the entry? Simple, sir. Equity share capital will be reduced. Equity share capital will be saved. So, why we, is there any requirement? Is there any need to write this entry? Sir, both are same cancel, sir. No, sir. No need. Don't do like that. Simple, because the face value is 100 rupees is reduced. We are reducing the 100 rupees share capital. We are now creating 10 rupees share capital. Definitely have to mention this face value amount. Amount will be same, sir. Amount is same, but the number of shares increased right now. Now the number of shares is increased. Previously 10,000 shares. Now it is 1 lakh shares. Correct? Previously, how much, sir? 10,000 shares. Now it is 1 lakh shares. Are you getting my point? That's it. Clear? Equity share capital to equity share capital 100 rupees, 10 rupees total. See here. One more point here. Here, if it is, if the paid up value is, okay, so general entry, what is the entry, sir? 1 lakh to 1 lakh, correct? Okay, this is the general entry normally. If the paid up value is, if the paid up value is 75, then what is the entry? 7 lakh 50,000, 7 lakh 50,000. Simple, sir. Just a paid up value is 75 rupees. Paid up means 75 into how much? 10,000. Correct? 7 lakh 50,000. Now each equity share is of 100 rupees into 10 shares. Correct? Yes, sir. No. Yes, sir. So then the value becomes how much? 7 lakh 50 only, but the face value is 10 rupees, right? But the face value is 10 rupees. Same entry amount will get changed because we have to write only paid up value, right? Yes. Next, consolidation of 10 rupees share to one share of 100 rupees. See, now I'm consolidating the shares. 10 shares will be divided, 10 shares will be consolidated into one share. So, for example, the share value is 10 rupees. I'm consolidated 10 shares of 10 rupees each, then it will become 100 rupees. So, one share of 100 rupees. That is nothing but consolidation. So, the entry becomes reversed. Equity share capital to equity share capital, 10 rupees, 100 rupees. 10 is reducing, 100 is creating, crediting, nothing but. Correct? Are you getting my point? Simple. This is the consolidation entry. This is the subdivision of shares. Next, conversion of equity shares into equity stock. Conversion of equity shares into equity stock. Simple. Equity share capital to equity stock. Equity share capital to equity stock account. Simple, sir. Equity shares are converted into equity stock. That's why you have to reduce equity share capital. So, equity share capital to equity stock. Next, reduction of share capital. Equity shares of 100 rupees each reduced to 40 rupees each. So now the value of a share is 400 rupees. Now it is reduced to 40. Reduced to 40. Present the value of equity share is 40 rupees only. But what is the balance 60 rupees? It is a gain to the company. That is the a gain to the company. Are you getting my point? Simple. Gain means transfer to capital reduction account. Okay now. So now the entry will be equity share capital 100 rupees you should debit it because there is no 100 rupees face value of shares right now. Now we have only 40 rupees shares. So that's why you have to debit all the 100 rupees shares value. So, for example, it is the 10,000 shares at the rate of 100. How much? 1 lakh, 10 lakhs. Correct? Now the value becomes 10 lakhs to 40 lakhs. Sorry, 4 lakhs. Correct? So 10,000 shares into 40 only you should take. So 10,000 into 40, 4 lakhs. So balance 6 lakhs will be transferred to capital reserve account. That's the benefit, sir. That's the benefit. So such benefit will be transferred to capital reduction account. Are you getting my point? So for example, the similar question, it is not reduced to, it is reduced by. If the question is given like this, equity share of rupees 100 rupees each reduced by 40 rupees each. Reduced to means the value reduced to 40 rupees. Reduced by means reduced 40 rupees. 40 rupees reduced means now it is at 60 rupees. That is the difference, sir. Please mind that point. Simple, same entry. 100 only, now equity share capital will be at 60 rupees, which means reduced by 40 rupees each. Out of 100 we are reducing 40. Now the value at 60 only. So the equity share capital is 60. The balance how many? 40. So 40 is the capital reduction. 60 is the equity share capital. If the question is reduced to, then it will become changes. Reduced to means present the value is at 40. So that means 60 rupees is a benefit to us. So that's a 60 rupees transfer to capital reduction. That's it. So please don't uh, forget that point. Very, very important. Okay, now. Next, assets value of 10 lakhs revalued at 9 lakhs. Asset value present 10 lakhs actually. It was revalued at 9 lakhs. The value becomes reduced. Correct? So asset should be credited. So to asset account, capital reduction will be debited. Is there any benefit or loss? It will be transferred to capital reduction. Simple. Whether it's a, if it is upward, it is a benefit to us. It is a downward, it is a not a benefit to us. So still you should transfer to capital reduction account. Okay, now. Next, face value 100, called up value 70, uncalled 30. Now called up capital, uncalled capital, called up. Simple, sir. Face value 100. I have called 70 rupees only. Okay, I want to call that 30 rupees also from shareholders. So it's a assume it is a final call. So then entry will be share final call to share capital account. What is that, sir? Share final call to share equity share capital account. I'm calling that last call. First, this is the due entry. Everyone knows about. I think so. This is a due entry, and then you should write the receipt entry. Correct? This is the just wait. This is the due entry. This is the receipt entry. Okay, now. So first due entry will be share final called equity share capital, and then you will receive the cash from equity shareholders. So then bank to share final call. Net entry will be what is the net entry? Share final call cancel. Bank account debit to equity share capital account. This is the net entry, right? Actually, this is the net entry. But we have to write the due entry initial and then receipt entry. Okay, now. Due entry means we are assuming the money will receive from shareholders. Okay, now as per accrual concept, you should write this entry. And then you have received that amount, then it will be transferred to share final call, not share capital. Okay, it's a mistake, sir. Please don't do that point. Please don't do that mistake. First entry, share final call to equity share capital, and then the share final call will be closed. So bank to equity share final call. The net entry will be bank to equity share capital. That is the entry. And then lastly, write off the goodwill and preliminary assets and P&L debit balance, etc. So first initially, so for example, capital reduction balance is net balance is. So for example, total credits is 10 lakh and to 10 lakhs. Assume just I'm Saying example, see here. Capital reduction credit balance is 10 lakhs. Capital reduction debit balance is 3 lakhs. Then net balance how much? 7 lakhs. 7 lakhs is the capital reduction credit balance. Then do nothing but benefit. So we have 7 lakhs of credits. With that, you should write off the P&L. Suppose example 3 lakhs. Goodwill 2 lakhs. Okay, preliminary expenses 50,000. Balance how much? 7 lakhs. 5.5. Balance how much? 1.5. It should be transferred to capital reserve account. That is the point. Are you getting my point? Correct. I have a capital reduction of rupees 7 lakhs value. Out of 7 lakhs, I have write off first initially P&L debit balance, and then come to goodwill, and then come to preliminary expenses. Is then a balance transferred to capital reserve account. So if any balance in capital reduction, transfer to capital reserve account. That is the point. Clear? Please repeat that. Okay. Let us go with an example. Simple. Preference share capital is to be converted into 12% unsecured debentures of 100 rupees each. With regard to 70% dues including arrears, and for balance equity shares to be issued of rupees 50 paid up. Given preference share capital is 4 lakhs of 100 rupees each. Preference dividend arrears 60,000. Okay na? Clear? Are you getting my point? This is the example, best example. Before going to, please tell me some examples. Plant and machinery upward revalued by 50,000. Upward revalued by 50,000. The entry. Upward means asset will be increased. So plant and machinery account debit to capital reduction account. How much? 50,000. Please identify this point. Reduced by 50,000. Sorry, reduced not revalued. Upward. So increased by 50,000. Nothing but 50,000 increased. So 50,000 transferred to capital reduction account. Suppose example, if it is 50 revalued to 50,000. Suppose example, initially the value is 30,000 only. In balance sheet, the plant and machinery value 30,000. It is increased upward revalued to 50,000. Nothing but how much increased? 20,000 increased. This is the point you should identify. Now the 20,000 only transferred to capital reduction. That's it. Okay na? Simple. Present the preference share capital is 4 lakhs of 100 rupees each, right? Very, very important, sir. Very, very important point. Present preference share capital is 4 lakhs of 100 rupees each share. Next, preference share capital is to be converted into 12% unsecured debentures of 100 rupees each with regard to 70% dues including arrears, and for balance equity shares to be issued at 50 rupees paid up. Simple, sir. The point is saying that preference share capital should convert into unsecured debentures. How much? 70% of the dues including arrears. What's the arrears here? 60,000. Correct. So first of all, you should transfer the preference share capital to preference shareholders because it is related to preference shareholders only, right? So first transfer that preference share capital to preference shareholders, and then we will settle. So first entry, preference share capital to preference shareholders. Okay. Next, here see the point. Contingent liability. Preference dividend arrears how much? 60,000, right? It is shown as a contingent liability, right? Contingent liability. Okay. Now we are paying it, which mean here, please read this point. 70% of the dues including arrears. Nothing but we are considering it is a liability right now. Correct? We are considering that it's a liability. So you have to create that liability. Generally contingent liability not recorded in books of accounts. Correct. It is saying that contingent liability preference dividend area is 60,000. It's a contingent liability. So now you are creating the liability. So it will be benefit or loss? Loss. So it will be transferred to capital reduction only. So entry will be capital reduction to preference dividend account. This is the main point. Are you getting my point? So now it is liability to the entity. So capital reduction account debit to preference dividend 60,000. Such a preference dividend also should be transferred to preference shareholders only. So preference dividend to preference shareholders 60,000. Now the preference shareholders balance is 4 lakhs plus 60, 4 lakhs 60,000. Out of 4 lakhs 60 you have to pay. You have to give unsecured debentures of 70% of the value. Simple. Preference shareholders 4 lakh 60. We are giving unsecured debentures 4 lakh 16 to 70%, 3 lakh 22,000, and the balance will be, and for the balance we are giving equity shares of rupees 50 paid. Correct? So balance is 1 lakh 38,000 divided by 50. How many shares? 2,760. 50 rupees each, right? The total number of shares 2,760 shares were issuing again. This is the special point. For this, we have write 4 entries, sir. Very important. The main point is contingent liability. If the preference dividend is shown as a contingent liability, first of all, you should create the liability, nothing but liability. It is a benefit or loss, loss to the entity. So that's a capital reduction to preference dividend. Such a preference dividend transferred to preference shareholders only. So preference dividend to preference shareholders. Okay, now are you getting my point? And then we will settle by issuing unsecured debentures and issuing equity share capital. That's it. Clear? This is one example. Next example two. Shivaji decided to reconstruct interest of rupees of X and Y in Gayatri Limited. Okay. 12% first debentures for X is 3 lakhs, Y is 2 lakhs. 12% second debentures for X is 7 lakhs, Y is 3 lakhs. Trade payables 2 lakhs, 1 lakh. The total is 12 lakhs, 6 lakhs. This is the question. This is the interest of X and Y in Gayatri Limited. X have first debentures is 3 lakhs. Y have first debentures is 2 lakhs. X have a second debentures is 7 lakhs. Y have a second debentures of rupees 3 lakhs. X have trade payables 2 lakhs. Y have trade payables 1 lakh. Total 12 lakhs, 6 lakhs. Next. X is to cancel 7 lakhs of his total debt other than the share amount. X wants to cancel 7 lakhs of his total debt other than the share amount and to pay 2 lakhs to the company and to receive new 14% first debentures for the balance sheet for balance amount. What is the total amount due for X? 12 lakhs. Out of 12 lakhs, 7 lakhs is to cancel out of his total debt. Okay, 7 lakhs he has to cancel. Balance how much? 5 lakhs. And again, he's paying 2 lakhs to the company. Again, pay 2 lakhs to the company. So nothing but we have to company has to pay total balance 5 lakhs plus 2 lakhs, total 7 lakhs. For that they are issuing new equity shares. Correct? Yes or no? See the first entry. First of all, what is the X total due? 12 lakhs. So first debentures, second debentures, trade payables. Everything transferred to X account. So this is the liability. Company has to pay 12 lakhs to X. Okay, company has to pay 12 lakhs to X. And also again 2 lakhs received from 2 lakhs received from X, nothing but bank to X account, bank to X account 2 lakhs. Now the balance due to X is 12 plus 2, 14. 12 plus 2, 14. Out of that, 7 lakhs is cancelling by the X. 7 lakhs is cancelling, nothing but our liability is reduced. Please think a company point. Our liability reduced. We don't need to pay 7 lakhs of rupees. That is transferred to capital reduction account. And for the balance, they are issuing 14% first debentures. So the entry will be X account debit 14 lakhs to 14 to capital reduction 7 lakhs to 14% debentures 7 lakhs. This is the entry. Are you getting my point? This is the entry. So for Y also same. Y is to cancel 3 lakhs of his total at other equity shares and to accept new 14% debentures for balance. Simple. What is the total due? 6 lakhs. Out of 6 lakhs, so everything transferred to Y account. So 12% debentures first debentures account, 12% second debentures account, trade payables account to Y account 6 lakhs. Next Y account 2, what we are giving is cancelling 3 lakhs. So to capital reduction 3 lakhs and for the balance 14% debentures will be given. Simple. Y to 14%, Y to capital reduction 3 lakhs, 3 lakhs. These are the entry and previous question also. Last exam, same question repeated. Are you getting my point? Clear? Very simple. Yes. Example. Trade creditors 165 lakhs. 40% creditor accept equity shares of rupees 2.5. Balance pay in cash. Simple, sir. Company liability for trade creditors is 165 lakhs. 40% creditors accept equity shares of 2.5 each. How much, sir? 2.5 each. So 40% means 165 into 40%. How much? 66. For 66 lakhs, company is giving equity shares. So trade credits are 165. To equity share capital 66 lakhs. How many shares? 66 lakhs by 2.5. 26.4 shares. 26.4 lakhs into 2.5. 66 lakhs. And for the balance, pay in cash. How much? 165 minus 66. Balance 99. So we are paying cash. Simple. 40 creditors accept equity shares of at the rate of 2.5 each. Okay. So out of 165, 40% is 66. So we are giving 66 value of equity shares. Number of shares is 66 lakhs by 2.5, 26.4 lakhs. And the balance paying cash. That's it. This is simple, sir. Very, very simple. So come to question number 15. Okay. Examination point of view, important questions are last attempt 10 marks from this topic. 10 marks or 5 marks? Okay, 5 marks. So
Okay, guys, I think, sorry, no, yeah, under Ind AS 103, we uploaded regarding the common control transactions and reconstruction and realization account related problem. Okay, so, and few more problems we need to practice. You need to practice actually. Okay, so, the point is, you need to solve all the questions given in the marathon first. Solve all the questions given in the marathon. Okay. Next, second point is under business combination also some theory questions important like control definition, which is defined under Ind AS 110 actually. Next, loss of a control related theory is also there, which is also defined in 110. And Ind AS 103 and AS 14 difference is also important for theory purpose. ఓకేనా. అండర్ CFS, go with the chain holding concept. Go with it, which is already in a YouTube channel, Telugu as well as English also, no issue for that. So, chain holding concept. Are you getting my point? Are you clear? Under business combination, reverse acquisition concept, which was not never till now, which was not asked in the exam. So go through that reverse acquisition topic, which is available in the YouTube channel. So search that, or I will provide the link in the YouTube channel. Again, go with that. That's it. And also economic value added theory also available in the YouTube channel. I will upload that video. Again, I will send the link in YouTube Telegram channel. Okay na? So everything available. Clear. So with this marathon, easily you can crack. Okay, so one more point I already discussed about the theory. You should go with a marathon 2.0. In that theory is there, go with that. That's it. Okay now, are you getting my point? So in that everything theory is there, like XBRL, okay, government accounting, everything is there. GASAB questions, so many. I'll explain clearly about that, about the theory topics, everything in that marathon 2.0. Go with that, you will get a full clarity about it. That's it. So this is more than for exams. Okay, easily you will get an exemption. Okay now, I hope everyone this marathon was very helpful. Okay, so if you like the video, please comment, share, like, subscribe. ఓకేనా, చేయండి. ఓకేనా, తెలుగు స్టూడెంట్స్ కూడా మీరు అందరూ చేయండి అమ్మ. ఓకే, సబ్స్క్రైబ్ చేయండి, షేర్ చేయండి, లైక్ చేయండి. అండ్ వెయిట్ ఫర్ ద MCQ session, which is uploaded in YouTube channel only. Within 3 to 4 days it will take, because we have a BV marathon, so business valuation marathon, right? So once we are done with BV marathon, I think it will upload in mostly 2nd June. Okay, sorry for this much delay, but it will be more helpful. Okay now, mostly Sunday, right? Sunday, yes, Sunday it will get upload. What is that? BV Sunday BV will upload. Go with that. Definitely you will get a, out of 50 you will get a 35 marks minimum. Basic, I am ignoring the theory only. Go with the theory, but including choice I will cover all the 50 marks. Okay now, even for regular every student can watch that BV marathon. I'm explaining with the clear examples which is given in the questions itself. Okay now, thank you guys, thank you so much, thank you so much for your support. So వీడియోని అయితే లైక్ చేయడం మర్చిపోకండి, సబ్స్క్రైబ్ చేయండి, షేర్ కూడా చేయండి. ఓకేనా, థ్యాంక్ యూ గైస్, థ్యాంక్ యూ సో మచ్, బాయ్ బాయ్.